Welcome to the deep dive. You know, there's so much noise out there on financial news.
Oh, absolutely.
So today, we're really cutting through that. We want to hit the core question, the one that really determines your financial safety. When is trading, well, actually just gambling? We're unpacking that essential foundational difference between investment and speculation.
Right. And the source material gives us probably the only reliable standard set way back in 1934.
1934, wow, okay.
Yeah. An investment operation, it says, is one that, only after thorough analysis, promises two key things.
Okay, what are they?
One, safety principle, and two, an adequate return. If you don't hit both of those marks, with speculation, by definition.
That definition feels incredibly strict now, doesn't it?
It does, yeah.
Because look at how Wall Street seems to have completely blurred those lines. They call pretty much everyone an investor now.
That's true.
Even, traders making super risky, leveraged bets. It's just wild to think that back in, 1948?
Yep, 1948.
Over 90% of the public actively avoided common stocks. Why? Because they correctly saw them as not safe, a gamble.
Exactly. That historical contrast really hammers home how confused the language, the terminology is today.
So it's not just the action, it's the thinking behind it.
It is. The distinction is rooted entirely in the mindset. What's fascinating here is how an investor judges the asset's current market price against established standards of intrinsic value.
Okay, looking at the fundamentals.
Right. Whereas a speculator,
Yeah.
they do the opposite. They base their entire standard of value upon the current market price. They're basically chasing the, quote, not the actual underlying business.
Ah, got it. So the main danger isn't necessarily speculation itself, but doing it badly, like unintelligent speculation.
Precisely.
What are the biggest traps the sources warn us about there if someone listening steps into that territory?
Well, they list three major pitfalls. Number one, and this is crucial, speculating when you actually think you're investing. Believing you're being safe when you're not.
Okay, that's dangerous. What's two?
Two is speculating seriously, like trying to make it your main gig without the proper knowledge or, frankly, the skill required. It's not easy.
Right. Requires deep expertise.
Definitely. And number three, risking money that you fundamentally cannot afford to lose, your essential capital.
That sounds like the core message is you need to recognize speculation for what it is, more like a pastime, maybe. Not a profession for most folks.
Absolutely. Treat it like a limited side hobby or, a gamble, plain and simple.
So there's a role for that.
There is. The sources recommend if you choose to speculate, you absolutely must put aside a small separate fund,
How small?
preferably no more than, say, 10% of your total capital.
Yeah.
And crucially, never, ever let those speculative operations mingle with your true long-term investments. Keep them walled off.
Okay, that 10% rule provides a really clear boundary for the fun money, so to speak.
Exactly.
So what about the other 90% then? That foundation. The sources lay out a policy for what they call the defensive investor, right?
That's the term, yeah.
Meaning the listener who's mainly interested in safety and, freedom from constant worry and bother.
Correct. And the policy is actually pretty straightforward.
Yeah.
You divide your holdings between two main buckets, high-grade bonds or cash equivalents,
Okay, the safer stuff.
and leading common stocks.
And is there like a magic ratio?
Not magic, but a guideline. Diversification and constraint are key. Maintain the proportion so neither bonds nor stocks dip below 25% or go above 75% of your total.
So keeping it balanced.
Right. And for simplicity, a 50-50 split is often the easiest choice. Then you just adjust it back towards 50-50 whenever the market's movement shifts the ratio by, say, 5 percentage points or so.
Just a little rebalancing now and then.
Yep. But what's really fascinating here, and maybe a bit sobering, is how history constantly reminds us that safety is never, ever guaranteed, even where you think it is.
How so?
Well, look at the period from 1964 to 1971. High-grade corporate bonds, the supposed bedrock of safety, right?
Yeah, you'd think so.
They experienced a maximum price decline of about 38%.
Wait, 38%? On high-grade bonds?
38%.
Yeah.
It completely shatters that myth of, fixed income always being perfectly safe.
Wow. That really proves the point. During that period, then, what did work?
Ironically, short-term cash equivalents actually did better than common stocks, which totally runs counter to all the standard inflation theories of the time.
So it just goes to show you really can't predict these things.
It illustrates it perfectly. Security prices, their future movements, they're truly never predictable.
Okay. So since the markets themselves are basically unknowable,
Your fundamental job actually shifts.
Right. So what does this ultimately mean for you, the learner, listening right now? Since you absolutely cannot predict the behavior of the markets, well, your primary job, your real job, is to learn to predict and control your own behavior, your emotions, your financial decisions.
That's the core of it. And maybe one final provocative thought, especially for the active investor out there, the one aiming to beat the average. You almost have to follow policies that are, one, inherently sound based on value and analysis, A and D, two, not popular on Wall Street right now.
Not popular. Why?
Well, think about why famous, often simple strategies, like old formulas based on easy stock metrics, the foolish four type things, why do they eventually seem to start working? Especially once everyone starts using them.
Ah, because they become too popular.
Exactly. As the source suggests, they become subject to a self-destructive process akin to the law of diminishing returns. Once the clever trick becomes common wisdom, well, the advantage of the trick just disappears entirely.
Food for thought. Okay, let's unpack this. Our deep dive today is all about, well, maybe the biggest worry for any long-term investor: inflation.
It really is, that persistent threat.
Exactly. And we're looking at some classic investment thinking, specifically that really optimistic advice you heard a lot in the late 90s.
Oh, yeah, the idea that you should be, 100% stocks?
100% stocks, 0% bonds. That was the claim. You had figures like Maryland State Treasurer Richard Dixon pushing it. It seemed like bonds were just obsolete back then.
Well, it's an attractive idea on the surface. I mean, inflation is just brutal for anything based on fixed dollars, right?
Mm-hmm.
Bonds get absolutely hammered.
Because the income, the principal, it's fixed. It loses value.
Precisely. And the assumption with stocks is, well, companies raise prices, maybe dividends go up, so you're protected.
It sounds logical, a natural hedge.
It sounds logical. But saying high-quality stocks are always better than bonds, no matter the price you pay or what the market's doing,
Yeah.
it's a fundamental misreading of the actual history.
Okay, so where does the history immediately push back on that all-stock idea?
Oh, you'd think stocks would just follow inflation upwards, right? But they don't always. Not closely.
Got an example?
Sure. Look at, say, 1966 to 1970. Cost of living, up 22%. That was the biggest 5-year jump since the early 50s. Huge inflation.
Okay, so stocks must have soared.
Nope. Both stock earnings and stock prices actually went down during that exact period.
Wow. So no guaranteed link there at all.
None. No close time connection. Which brings up maybe the bigger risk. It becomes psychological.
What do you mean? If inflation isn't directly killing stocks, what's the danger?
It's what it does to how we see wealth. We fall for the money illusion.
Money illusion. That sounds intriguing.
It means we focus just on the nominal gains. The number on the page, how many dollars you have.
Rather than what those dollars can actually buy. The real gain after inflation.
Exactly. So you think you're doing great, but your actual purchasing power might be shrinking.
So the danger isn't just losing money, it's thinking you've gained when you've actually lost ground.
That's it precisely. Think back to 1980. People were thrilled, right? Getting 11% on bank CDs. Huge number.
Sounds amazing.
But inflation was raging even higher. So in real terms, they were losing purchasing power.
Okay.
Now, contrast that with, say, 2003. Maybe you got a 2% return. Felt kind of,
Yeah, disappointing on the surface.
But inflation was super low then, so that 2%, it actually kept pace. You held your ground. The headline number can fool you. Inflation eats away silently.
Right. And even if inflation seems low now, you absolutely have to prepare for the risk it could return. We've seen it happen.
We sure have. That period, 73 to 82, nasty stagflation. Prices more than doubled. That's like a 9% annualized inflation rate.
Ouch. And there's a political angle too, isn't there? Governments maybe don't mind a little inflation.
Well, let's be impartial, but there's certainly an economic self-interest. Yeah. If you have massive national debts, inflation lets you pay them back with cheaper dollars later on. It's politically easier than some other options.
So you need protection. But stocks aren't a perfect shield, you said.
Not perfect, no. Only a partial hedge. Looking back to 1926, stocks actually failed to keep up with inflation in about 22% of all 5-year periods.
So almost a quarter of the time, they lost ground in real terms over 5 years.
That's right. And interestingly, stock returns tend to be poor, not just during really high inflation, say, above 6%, but also during deflation, when prices fall. They don't like extremes.
Okay, so if regular stocks are a mixed bag, what else can investors look at specifically for inflation protection?
Well, there are more modern tools. First, you've got REITs, real estate investment trusts.
Companies that own properties collect rent.
Exactly. Rent tends to rise with inflation over the long run, so they offer some defense. It's not perfect, but it helps.
Makes sense.
What else? Second, there are tips. Treasury inflation-protected securities, U.S. government bonds.
And how do they work?
They're designed specifically for this. Their principal value automatically increases when the official inflation measure, the CPI, goes up.
So the bond itself grows to keep pace with rising prices. Guaranteed protection.
Guaranteed against purchasing power loss on the principal, yes, but this brings up a really important detail you need to know about taxes.
Okay, let's hear it. If the bond's value goes up just because of that inflation adjustment, is that taxable, even if I haven't sold it?
Yes, it is. The IRS counts that increase in value, the inflation adjustment, as taxable income for that year.
Even if it's just a paper gain, you haven't actually received that extra cash.
Correct. Even if it's just on paper, which fundamentally changes where you probably want to own these things.
Right, because you could owe taxes on income you haven't technically received yet.
Exactly. So the smart move for most people is to hold TPS inside tax-deferred or tax-advantaged accounts. Think IRAs, 401k.
That way, those paper gains aren't taxed year after year. You defer the tax until you withdraw the money in retirement.
That's the strategy. Otherwise, you might be protected from inflation on paper, but get hit with a tax bill you need cash for.
That is vital context. Okay, so summing up, the future's uncertain. You can't just bet everything on one horse, whether it's stocks or bonds.
Absolutely not. Balanced diversification.
Mm-hmm.
The conservative investor has to focus on minimizing risks above all else.
All right, let's leave our listeners with a final thought to chew on, something maybe a bit counterintuitive.
Okay.
Think about public utilities. Electricity, gas, phone companies, historically, they're often seen as victims of inflation, right? Regulation holds down prices, borrowing costs go up.
That's the common view, yes.
But look at their actual unit costs over the long haul. Electricity per kilowatt hour, gas per therm. They've often risen much less than the general price index.
Why would that be?
Well, think about their business. Massive upfront investments, power plants, pipelines, networks, paid off over decades. Their major costs are sort of locked in, less sensitive to sudden price spikes than, say, a company constantly buying raw materials.
Interesting. So their long-term cost structure gives them a kind of built-in buffer.
Potentially. It's something to consider. This structure might actually make them a surprisingly resilient part of a portfolio designed to weather inflation over the very long term, something to mull over. Welcome to the Deep Dive. Today, our mission is, well, pretty vital. We're cutting straight into a century of stock market history. We're talking 1871 to 1972, really asking, do high past returns actually guarantee future success?
Right, and this isn't just academic. We're looking at a period where the analysis gave the exact warning signs for a major collapse, 1973-74. And the lessons here, they echo straight through to the dot-com bubble bursting in the early 2000s. Really profound stuff.
So the goal is to see how that relationship between prices, earnings, dividends, how it changes and signals danger.
Exactly. For the conservative investor, understanding that shift is absolutely key.
Okay, let's unpack this century then. Our sources break it down into three pretty distinct patterns. First up, 1900 to 1924. Slow and steady, right? Like a 3% annual advance.
Yeah, pretty modest. Then comes the second phase, 1924 to 1949. Much more volatile, irregular fluctuations, and a really meager 1.5% annual advance overall. And the crucial takeaway here is by 1949, public enthusiasm for stock was basically rock bottom. People saw them mostly as, speculative.
Which kind of ironically set the stage for what came next. Period 3, 1949 to 1968. This is the big one, the greatest bull market. An average compounded rate of 11% a year, and that's before dividends.
Right, and this is where the psychology flips. Those amazing, consistent returns, they created this illogical and dangerous conviction that things would just keep going up like that forever.
But that conviction started to crack, not with a bang, but more like a slow leak, right? Which brings us to the warning signs in early 72.
Exactly. And the fascinating thing is this complete reversal in yields. Think about 1949. The S&P dividend yield was over 7%, really solid. Meanwhile, high-grade bonds, paying just 2.6%. So stocks yielded more than twice what bonds did.
Okay, but then jump ahead to early 1972. The S&P dividend yield, it's cratered, down to just 3.11%. And bond interest, it soared to 7.57%.
Completely flipped. Bonds, the supposedly safe asset, are now yielding more than double what stocks are paying in dividends.
So, wait, even if the price-to-earnings ratio wasn't crazy high, it's about 18 times 3-year earnings, right? Why did this yield flip matter so much? What was the danger?
The danger was losing your risk premium. See, a bond is basically guaranteed interest, low risk. Stocks are higher risk, so historically, they have to offer a higher return, that premium, to make taking that risk worthwhile.
Good.
When the riskier asset pays less than the safe asset, that whole logic breaks down. That's why, even with moderate PE ratios, the market in early 72 was, frankly, unattractive from the standpoint of conservative investment.
And that caution was proven right very quickly. The 73-74 bear market was catastrophic.
Absolutely vindicated.
So it seems the big mistake wasn't just about valuation numbers. It was this belief that the past predicts the future in a straight line. And that flaw, this bull market baloney, it just keeps coming back, doesn't it? Like in the 1990s.
Oh, absolutely. Roaring back. You had gurus pushing books like Dow 100,000. And their whole argument rested on extrapolating history. They'd say, look, stocks have returned 7% after inflation since the 1800s.
But there's a huge problem with that super long-term data, isn't there? Especially before 1871.
A fatal flaw, survivorship bias. Those really early indexes, tiny, sometimes just 7 stocks. They only tracked the winners, the ones that survived. They completely ignored the thousands, literally thousands of companies that went bankrupt.
Yeah.
Think Dismal Swamp Canalco, levels of failure.
Right.
So if you ignore all the failures, your average return looks way, way better than what real investors actually experienced. It's like cheating because you already know who wins.
And that flawed view let optimism just run wild in the dot-com boom. I remember pundits asking, almost scoffing, is the market riskier just because prices are higher? The answer is no.
Famous last words. The reality was a brutal $5 trillion yes. The NASDAQ crashed from over 4,400 down to what, around 1,300? Just think, investors lost over $400 billion on Cisco Systems alone. Why? Because they focused on those historical averages, not the price they were actually paying.
Which also comes back to that core idea. The value of any investment depends on the price you pay.
Always. It has to.
So bringing this home for listeners today, instead of just blindly projecting the past, what's the framework? Graham's ideas.
Exactly. Use Graham's framework for realistic expectations. He says long-term returns really boil down to just 3 things: real growth, inflationary growth, and dividend yield.
Okay, so how would that work? Like if we looked at early 2003, for example.
Well, you'd estimate the components: real growth, that's productivity, maybe 1.5 to 2%. Then add inflationary growth, say around 2.4% back then. And finally, add the actual dividend yield at that time, which was about 1.9%. You add those up.
And you get roughly 6%.
Around 6%. A reasonable, fundamentally grounded expectation.
Which sounds, well, maybe a bit boring compared to the double-digit returns people dream of from the 60s or late 90s.
Maybe boring, but it's based on actual economic factors, not just wishful thinking about repeating history.
So the big takeaway then?
I think the only real truth history teaches us is that the future, it's always going to surprise you. Always. And the market saves its most brutal surprises for those who are absolutely certain about their forecasts.
So staying humble, focusing on the price you pay, that's the best defense.
And that really is the investor's best defense. Absolutely.
Welcome to the Depth Dive. Today, we're really zeroing in on you, the defensive investor. We want to pull out the absolute core policies you need for safety and security. Our goal is to nail down that foundational asset allocation or stocks versus bonds, and then really get into the details of that bond component. I want to kick things off with something that maybe challenges how we usually think about investment returns. We always hear return is tied to risk, right? But our sources, they suggest that's maybe a bit misleading for the intelligent investor.
Yeah, that's a key point. The correction here is fascinating. The rate of return you should be aiming for really depends on the amount of intelligent effort you're willing and able to put in. You know, the passive investor, the one really looking for safety, freedom from worry, they get the minimum return, maximum returns. Those are for the investor who's alert, enterprising, doing the work. So the variable isn't just blind risk, it's the quality of your effort.
Okay, so let's apply that. For the defensive investor, the one choosing safety, maybe less day-to-day effort, the main policy seems to be splitting funds. High-grade bonds, high-grade common stocks, and there's a fundamental rule here. Never less than 25% in stocks, never more than 75%. And the reverse for bonds, obviously.
Right. And within that range, we actually propose something, well, almost oversimplified. The 50-30 formula. Just an equal split. For most defensive investors, that's the simplest starting point. An all-purpose program, really.
Hold on, 50-50. I mean, that sounds incredibly simple compared to all the complex strategies out there. Why would just an equal split be the go-to recommendation?
Because the real goal here isn't squeezing out every last bit of yield. It's about discipline. The power of the 50/50 isn't just the initial split, it's the mandatory rebalancing that comes with it. That's the crucial part.
Okay, so that's where the action is. Like if stocks soar and suddenly make up 55% of your portfolio, you have to restore that 50/50 balance, which means selling, what is it, 1/11 of the stocks and putting that cash into bonds.
Exactly right.
Yeah.
That's the math to get you precisely back to 50/50.
Yeah.
And the main benefit, honestly, it's psychological. It stops you from getting sucked deeper into stocks when the market's potentially getting overheated, reaching dangerous levels. It forces you to sell a bit when prices are high.
Right. It enforces that sell-high discipline. And, okay, this is important too. We need to push back on the whole age fallacy, don't we? The standard advice is always, more bonds as you get older. But these sources argue that dismisses your personal temperament, your situation. So are you saying let's say, a successful 30-year-old with a stable job might actually need more bonds than a retired 65-year-old who has several secure income streams already?
Precisely. Your allocation should really depend on your emotional tolerance for market drops.
Yeah.
And your specific life circumstances. Do you need cash soon? How secure is your job? That minimum 25% in bonds isn't really there for income. It's there to give you the courage, as the source puts it, to actually hold onto your stocks during a big downturn without panicking and selling at the bottom.
Okay, let's shift focus a bit to the bond side of that 50/50. For this defensive investor, choosing between taxable corporate bonds and tax-free municipal bonds seems straightforward, just arithmetic.
Pretty much, yeah. It boils down to your tax bracket. If your maximum federal tax rate is higher than, say, around 30%, you typically end up with more after taxes by choosing good quality municipal bonds. Now, the exact income levels for those brackets change, of course, but the basic math comparing the muni yield to what a corporate bond would yield after your taxes, that calculation is key.
Got it. And this next point seems really practical, especially for people just building their foundation. For smaller amounts in bonds, say maybe up to $10,000 or so, U.S. savings bonds, they're highlighted as maybe the easiest, even the best choice.
For that situation, yes, they have this unique combination, absolute safety of principal. You can demand your money back anytime, basically. And you get this option to defer federal taxes on the interest until you cash them in. That's quite powerful for modest sums.
That combination of safety and tax deferral is hard to beat when starting out.
Now, just one quick warning about something that kind of sits between bonds and stocks. Preferred stocks. For you, the individual defensive investor, they're often, well, an inherently weak choice. You don't get the strong legal claim of a bondholder if things go wrong, but you also don't get the big potential upside of common stocks. And unlike for corporations, there's usually no significant tax advantage for an individual investor. So generally something to sidestep.
Okay, so pulling this all together for you listening, the defensive investor's success, it really seems to hinge on sticking to a disciplined strategy, like that 50/50 rebalancing rule. It's about the system, not trying to outguess the market.
Yeah, absolutely. Connects to the bigger picture. Your success isn't just about picking the right bond or stock. It's about understanding how you react emotionally, especially under pressure. So here's something to think about. If you accept you need that minimum 25% bond cushion just to avoid panicking in a crash, ask yourself this. What specific things in your life right now, job security, cash needs, dependence, might actually justify putting less than 50% into stocks, even if the market looks cheap today? Answering that honestly, that's probably the truest measure of your personal risk tolerance. Welcome to the Deep Dive. Today, we're going to unpack the core ideas for the defensive investor looking at common stocks using some classic investment thinking.
Yeah, and for that kind of investor, safety first is really the name of the game, isn't it? Not chasing huge gains.
Exactly. And the history here is, well, it's pretty interesting.
It really is. Our sources point out this odd flip. Back in 1949, everyone knew stocks were risky, speculative. Fast forward 20 years, prices were sky high, making them seem safe.
Which is, kind of dangerous thinking, that inversion.
Totally dangerous.
Because historically, stocks had two big pluses over bonds.
Huh.
They offered some protection against inflation, bonds often don't, and they generally gave higher returns over time.
And this is the crucial, but you lose all that benefit if you pay too much upfront.
Right. Just think about it. Took the Dow 25 years from 1929 all the way to 1954 just to get back to where it was before the crash.
Wow. Yeah. So paying the right price is your real defense. So how do you actually do that? How does the defensive investor build that stock portfolio?
Well, the sources lay out 4 key rules, pretty clear rules.
Okay.
Rule 1, diversify. You need enough different stocks, but don't go overboard. Think maybe 10 minimum, 30 maximum. Keep it manageable.
Makes sense. Okay, rule 2.
Rule 2 is about the quality of the company. You want large, well-known companies, and this is critical, companies that aren't loaded up with debt.
Conservatively financed is the term often used.
Exactly. For an industrial company, that means its common stock value, the book value, should be at least half of its total funding structure. Less debt, more stability.
Got it. Limits the risk. What's rule 3?
Dividends.
Yeah.
You want a long, consistent history of the company paying dividends, like maybe 10, ideally 20 years, without missing a payment.
That consistency shows strength. And dividends themselves, I mean, the power of reinvesting them is huge. Right?
Oh, absolutely huge. The classic example, $1 invested back in 1900. If you reinvested all the dividends, it grew to almost $17,000 by the time the source was written. If you just spent the dividends, only $198 difference.
Huge difference. Okay, so diversification, quality finances, dividends. What's the last rule? Rule 4.
Price. Putting a hard limit on what you'll pay relative to earnings. The price to earnings, or PE ratio.
Ah, the PE limit. Yeah.
2 limits, actually. Don't pay more than 25 times the company's average earnings over the last 7 years. And also, don't pay more than 20 times its earnings over just the last year.
So it's a double check. Keeps you from getting caught up in, market excitement.
Precisely. And if you stick to these rules, especially the price one, you automatically rule out a whole category of stocks.
Yeah, the growth stocks. The high flyers.
Why exclude them completely? Isn't that where the big money can be made?
It can be, but it introduces speculation. Growth stocks often trade at really high prices because people expect massive future growth. The price runs way ahead of current profits.
Betting on the future, basically.
Exactly. And that bet can go wrong. Think about Texas Instruments decades ago, or Cisco more recently. Incredible run-ups, then bam. Huge price drops when growth slowed even a little. Texas Instruments lost like 4/5 of its value in just 2 years.
Ouch. Okay, so if those rules help avoid that kind of thing, what's the real risk we should worry about? Market dips happen.
Right. Temporary price drops aren't the main danger for a long-term disciplined investor. The real risk is, well, a permanent loss, either because the company itself goes downhill significantly or, and this is usually the big one, because you simply paid way too much for the stock in the first place.
Paying too much relative to its actual underlying value.
That's the killer, which is why those PE limits are so important.
So how do we protect ourselves from ourselves, from making mistakes, behavioral stuff?
Good question. 2 main tools here. First is dollar cost averaging, DCA.
Ah, yes, the automatic investment plan.
Pretty much. You invest the same fixed amount of money at regular intervals, say, every month, no matter what the market's doing, up or down, same amount goes in.
And the thinking is, this stops you from trying to time the market.
Exactly. And historically, it works incredibly well as a defense. That 1929 example again, put a lump sum in right before the crash. 10 years later, still losing money.
Right.
But if you'd invested $100 every month through that period, by 1939, you'd actually have made a good profit. Discipline pays off.
Okay, DCA is one tool. What's the other?
Avoiding the buy what you know trap, sometimes called home bias.
Oh, interesting. Like investing heavily in your own company's stock or companies in your hometown just because they're familiar?
Precisely. Familiarity feels safe, but it doesn't actually reduce the investment risk. Worse, it can make you overconfident. You think you know more than you do.
And that leads to putting too many eggs in one basket.
Yeah, remember Enron. Lots of employees had huge chunks of their 401ks in Enron stock. They felt they knew the company. When it collapsed, they were wiped out. That familiarity bred complacency.
A tough lesson. So wrapping this up, it seems like successful defensive investing isn't really about having the most money.
No, not at all. It's about having the right mental toolkit. The knowledge, sure, the experience helps, but mostly it's about temperament, discipline, sticking to the rules.
So this idea of an automatic defensive portfolio using things like DCA, maybe index funds, it kind of frees you from having to predict anything, doesn't it?
It really does. You set the rules, you follow them, and you let the system work. It leads to a fascinating thought maybe for you to consider. What about the sheer power, the ultimate defense of being able to just say, I don't know where the market's going, and frankly, I don't need to care. Okay, let's unpack this. For the enterprising investor, success isn't always about picking the absolute winners. Sometimes it's maybe more about ruthlessly cutting out the potential big losers.
That's right. It's the negative approach.
Exactly. So our mission today, this deep dive, is really focusing on that. The critical things you need to actively avoid to protect your capital, protect your energy.
And the base, as you said, it's still sound. High-grade bonds, good stocks. That's your core. But when you start looking beyond that for maybe a bit more growth, That's where the pitfalls really open up.
Yeah. So prevention is key. What are the the easy first steps, the guardrails?
Well, there are a couple of general rules. Leave high-grade preferred stocks, mostly to corporations. They have tax advantages you don't. And maybe more importantly, be really, really wary of new issues, IPOs, generally speaking.
Okay, so those are maybe the more obvious ones, but let's get into the psychological traps, the ones that maybe catch even smart investors off guard.
Yeah, absolutely. Our sources point to three big ones, three active traps that just seem to consistently destroy investor wealth if you're not careful.
All right, let's start with trap one, the yield trap. Sounds tempting.
It is tempting. It's this classic idea, sometimes called the businessman's investment. You buy these second-grade, lower safety bonds just because they offer a slightly higher income.
Just chasing that extra percent or two.
Exactly. And it's bad business, fundamentally. You're risking your principal, your core investment, for what? A tiny bit more income each year.
Yeah.
If you're going to take on real risk, you need the potential for a substantial gain in the principal itself. Like buying a bond that pays 5.5%, but buying it way below par, say it's 70 cents on the dollar, not at 100.
Right, so you have room for capital appreciation plus the yield, not just the yield.
Precisely.
And the big example here, WorldCom, right, back in 2001. That feels like the poster child for this.
Oh, absolutely. A modern monument to this mistake. Investors saw these yields, some up to like 8.3%, which sounded fantastic at the time.
Very to track.
But the company's foundation, it was basically fiction. WorldCom hadn't actually covered its fixed charges, its basic obligations, by billions in the years leading up to it.
So the numbers are screaming danger, but people focused on the yield.
They did. And that's the key insight, isn't it? For that tiny extra reward, that 1 or 2% yield bump, people took on this catastrophic risk that could and did wipe out their principal.
And it did. When WorldCom defaulted, those bonds, they lost what, over 80%?
Over 80% of their value.
Yeah.
Gone. It's like buying a bond only for its yield is kind of like getting married only for the sex.
Yeah.
When the attractive thing inevitably dries up.
There's nothing left holding it together.
Exactly.
Flawed premise.
Okay, so the yield trap is about letting yield blind you to bad fundamentals. Trap 2, the popularity trap. This feels different. This is about getting swept up in hype, especially with IPOs, new issues. Precisely. This is where maybe the numbers get thrown out the window entirely. It's herd behavior. And IPOs are the classic case. You have to remember, new issues are almost always sold under conditions that are fantastic for the seller, usually near market peaks.
It's their exit strategy, not necessarily your best entry point.
You got it. It's an exit for insiders, not usually a value opportunity for new investors.
And the example for this, VA Linux in '99, that one was just wild, wasn't it?
Off the charts. It priced at $30 a share, opened trading at $299, briefly hit $320. Pure mania.
But the company itself, what was the reality?
The reality. The company was losing almost 70 cents for every single dollar of sales it made. Think about that.
So how does the market justify paying nearly $13 billion for a business that's hemorrhaging cash like that?
It doesn't justify it, not rationally. That's the frenzy. The valuation is completely detached from reality. The only thing driving it is momentum, hype.
And the inevitable outcome.
3 years later, the stock was $1.19. Yeah. It really drives home that cynical view of IPOs. You know, the acronyms people came up with. It's probably overpriced. Imaginary profits only. Or, my favorite, insider's private opportunity.
Or maybe idiotic, preposterous, and outrageous.
That works too. The terms are just set up for the seller.
Okay, so avoid chasing yield, avoid chasing hype. Trap 3, the activity trap. This one feels counterintuitive, hyper trading. Don't we feel like we're doing something, being productive by trading a lot?
We do feel that way. It's seductive, constantly tweaking, buying, selling. But the research is just incredibly clear on this.
The more you trade.
The less you keep. Simple as that.
Why? Is it just commissions?
Commission's part of it, sure.
Yeah.
But it's also the hidden costs. Market impact your own trades, moving the price against you slightly. Slippage, it all adds up. There was this landmark study, Barber and Odine looked at like 66,000 brokerage accounts.
Okay. And what did they find?
They found the most active traders, the ones turning over maybe 20% or more of their portfolio every month.
Wow, that's a lot of trading.
It is. Before costs, they actually slightly beat the market on average. But after factoring in all those trading costs, they underperformed the market by a whopping 6.4 percentage points annually.
6.4% worse than just buying and holding an index fund, basically because of trading costs.
Essentially, yes, that's the penalty for hyperactivity.
So putting it all together, these 3 traps. what's the big takeaway here? It sounds like the biggest threat isn't necessarily the market itself.
No, often it's us. It's self-sabotage, driven by impatience, maybe greed, this constant urge to do something.
So the lesson is patience.
Informed patience. The lesson really is a long-term investor is pretty much the only kind of successful investor there is, at least for most people.
Right. So we've hit avoiding the yield trap like WorldCom, avoiding the hype trap like VA Linux, and avoiding the activity trap, that 6.4% penalty.
Yeah, those are the big ones to actively avoid.
Okay, final thought then, connecting this. If the goal is informed patience, not constant action, I like this quote our source mentioned from the boxing trainer Angelo Dundee.
Oh, yeah. Which one?
He said, "The punches you miss are the ones that wear you out."
Interesting analogy.
Yeah. So the final thought for you, the listener, to maybe explore, how much unnecessary financial stress, how much energy have you maybe burned just by trying desperately not to miss out on the next trade, the next hot thing, something to think about.
Welcome to the Deep Dive. Today, we're really getting into what defines the enterprising investor, or EI.
Right. This isn't your passive index fund investor. We're talking about someone actively putting in the effort, the analysis.
Trying to beat the averages, basically.
Exactly. Serious time and attention on the portfolio.
And the classic texts lay out 4 main paths for this EI, don't they?
They do. You've got market timing, buying growth stocks, hunting for bargain issues, and then the more technical special situations.
Let's start with the one everyone wants to do. Market timing. Buying low, selling high. Sounds simple.
Ah, if only. It's incredibly tempting, but practically speaking, and emotionally, almost impossible.
Yeah, foresight is, well, it's not really a thing, is it?
Not reliably, no. Just look back. January 1973, Alan Greenspan, hardly an uninformed voice,
A
right?
giant in economics.
He was quoted as being unqualifiably bullish. And what happened right after?
Oof. The market tanked. One of the worst periods since the Great Depression.
Precisely. If the experts get it that wrong, relying on some formula or just your gut feeling, it's a dangerous game.
Okay, so timing is out. A lot of enterprising folks then pivot straight to growth stocks. Find the next Amazon, the next big thing.
Another siren song. And there are 2 big catches, really fundamental ones.
Which are?
First, everyone else sees those same bright prospects, so the price gets bid up, way up. You often end up overpaying.
Paying for potential, not current reality.
Exactly. And second, that super fast growth, it just can't last forever. Think physics. What goes up?
Eventually levels off or comes down.
Right. Remember the late 90s? Companies like Sun Microsystems, GE, even Home Depot, fantastic companies, no doubt.
But their price-to-earnings ratios were sky high.
Through the roof. Priced for perfection, for growth that never stopped, and then crash. It proves a great company isn't always a great investment, certainly not at any price.
So if timing is a bust and chasing popular growth means you're likely overpaying, what's left for the truly enterprising?
You look where others aren't, you flip the script. The recommendation is to focus on the relatively unpopular large company.
Large being the key word there.
Absolutely. These are established companies. Maybe they hit a rough patch, missed earnings, facing some pessimism. But crucially, they have the resources.
The capital, the management.
Or brain power, yeah.
Yeah.
To sort things out, to recover. Their unpopularity is often temporary.
Is there evidence this actually works better?
Oh, yes. There's a well-known study looking at the Dow Jones stocks, specifically the cheap ones based on low price-to-earnings ratios.
Okay.
From 1937 to 1969, these low-multiple unpopular stocks clearly outperformed the overall Dow index in, I think it was 25 out of 34 tests.
Wow. So being out of favor actually helped build wealth long term.
When applied to solid, large companies, yes, it leads right into the next strategy, actively buying bargain issues.
Bargain issues. How are we defining a bargain here?
The classic definition is a stock selling for substantially less than its underlying value. Think at least 50% more value than the current price, often found by looking at what the whole business would be worth to a private buyer.
Okay, assessing that intrinsic value.
And the most clear-cut identifiable bargain, it's called the net.
Net.
Yeah. It's a company where the stock price is less than its net working capital alone.
Wait, so you mean current assets, cash, receivables, inventory, minus all liabilities, total debt
That's right.
is still more than the market cap. You're essentially getting the buildings, the machinery, the brand for free.
Sounds crazy, doesn't it? But it happens. The market isn't always rational. It highlights extreme pessimism.
Does it work, buying these nets?
The data is compelling. A 1957 study looked at 85 of these stocks. Over 2 years, they gained an average of 75%.
And the overall market.
The S&P industrials were up about 50% in that same period. And critically, there were almost no significant losses among those 85 bargain stocks.
That's incredible. Why doesn't everyone just do this then? Seems like a sure thing.
Well, a few reasons. These situations aren't that common. Finding them takes work, and you need patience. Management might be the reason they're cheap.
Right. And it probably leads you into more complex territory.
It often does. Which brings us to the last category, special situations or workouts. This is definitely a more technical area.
Workouts, like mergers, bankruptcies, that kind of thing.
Exactly. Think merger arbitrage capturing the small spread between a deal announcement price and the current price. Or investing in companies going through complex reorganizations, bankruptcies, spin-offs.
Stuff involving lawyers and courts, generally.
Often, yeah. The old Wall Street saying never buy into a lawsuit usually holds, but the enterprising investor here is exploiting the fact that the market tends to undervalue things that look complicated or legally messy. It's a niche.
Okay, so summing up for you listening, timing is likely futile, popular growth is often overpriced, but unpopular large companies and true bargain issues, especially net nets, offer potential paths. And then there are these technical workouts.
The key takeaway from the sources is you really have to choose. Are you going to be passive and defensive, accepting market returns, or truly enterprising and aggressive, putting in the work these strategies demand?
There's no real middle ground for success, is there?
Not according to this philosophy. Trying to do a little bit of everything often leads to subpar results. Commit to a path.
And one final thought to leave you with, something to chew on. It's about concentration.
Ah, yes, the paradox. Andrew Carnegie famously said, put all your eggs in one basket and watch that basket. Making a huge fortune often involves intense concentration.
But keeping it.
That's different. Look at the original Forbes 400 lists. Track those fortunes over a couple of decades. Most of the original fortunes heavily concentrated in one industry or company. They didn't last. They got crushed.
So concentration might build wealth, but diversification seems key to preserving it. Something to think about. Welcome back to the Deep Dive. So today's mission, it's really vital, I think. We want to gain some deep insight into how an intelligent investor should handle market ups and downs, because they will happen, right? Stock and bond prices fluctuate.
Absolutely. And our sources, they really hammer this home. These swings aren't just random noise. They're often predictable psychological phenomena. The real trick for you, the investor, is keeping your long-term game plan totally separate from all that daily drama.
Okay, let's get right into that distinction then. The material draw a really sharp line between timing and pricing. Timing, that's trying to guess the market's next move.
Exactly, forecasting market direction.
Yeah.
Whereas pricing, that's about buying something when it's actually quoted below what you determine its fair value is.
And that difference is, fundamental.
Oh, completely. It determines everything. If you focus on timing, on forecasting, well, you're pretty much guaranteed to end up with a speculator's results, not an investor's. I mean, think about it. The general public can't really profit from market predictions because they're all just trading against each other based on those same predictions.
But if it's so flawed, why do you see so many, highly paid strategists constantly making forecasts? Is there some sort of psychological need it fills?
It can seem like that. It's often this feedback loop. Just look back at, say, March 2000. The NASDAQ hits its all-time high, and on that very day, you had strategists predicting it would soar even higher, like hit 6,000. History is littered with these failed forecasts. It really shows the futility.
Right. So forecasting is out. What's the intelligent investor's edge, then?
Yeah.
Our sources talk about freedom.
Precisely, freedom. Unlike maybe a fund manager who might face redemptions or someone using margin, you are typically not forced to sell your shares. You can just ignore the current price if it doesn't make sense based on your own judgment of value.
That leads perfectly into that famous allegory, doesn't it? Mr. Market.
Ah, yes, Mr. Market. Such a great way to picture it. Imagine you have a business partner, Mr. Market, and he's wildly manic depressive. Every single day, he comes to you and offers to buy your share of the business or sell you his, and the price he quotes. It's all over the place. Sometimes ridiculously high, sometimes ruinously low. It just reflects his mood that day.
Not the actual value.
Not the underlying value at all. So the intelligent investor uses Mr. Market like a servant. You listen to his offers, but you only buy or sell when his price is genuinely advantageous to you. You don't let his mood dictate your actions.
That really hits home. We all see Mr. Market having his mood swings on our screens. Let's look at a real case where his mood created a huge opportunity. A&P, the grocery chain.
Great example. The Great Atlantic and Pacific Tea Company. Back in 1938, there were some temporary fears floating around, and the market pushed A&P's total value, its market cap, down to about $126 million. But here's the kicker. At that exact moment, the company was holding $134 million just in working capital. That's stuff like cash, inventory, easily measurable assets.
Wait, so the market was valuing the entire company for less than its liquid assets?
Exactly. Less than its net current assets. It was a glaring error, a patent error, as our source calls it. The whole ongoing business was being offered for less than breakup value. Any alert buyer could see that. But then fast forward just a few years, the price soared. Contrast that with 1961, when everyone wanted A&P stock at 30 times earnings, a ridiculously high price, which also proved wrong very quickly.
So spotting an obvious error like A&P is one thing, but what about successful companies, the blue chips? There's a paradox there, right? The paradox of quality.
Yes, it's fascinating. The better the company, often the bigger the premium the market puts on its shares compared to its book value, its tangible assets. This actually makes its stock price more dependent on market sentiment, on Mr. Market's moods.
So high quality can sometimes mean more speculative price action.
Ironically, yes. Think about giants like IBM or Xerox back in their heydays. When market confidence just wavered a bit in the 60s or 70s, their stock prices could plummet dramatically, even if the underlying business was still fundamentally strong. The price was built so much on future expectations and sentiment.
Okay, so human nature pulls us towards the crowd, towards Mr. Market's mood. How do you fight that? We need some discipline.
Discipline is key, and the antidote our source suggests is a mechanical approach, something like systematic rebalancing between stocks and bonds.
How does that work?
Well, you set a target allocation, say 50-50 stocks and bonds. If the stock market surges and your stocks become, say, 60% of your portfolio, you automatically sell some stocks and buy bonds to get back to 50-50.
So you're forced to sell high.
Exactly. And if the market tanks, your stocks might fall to 40%. The system tells you to sell bonds and buy stocks to rebalance. You're forced to buy low. It takes the emotion out. Our source puts it beautifully. It gives an outlet for those otherwise too pent-up energies that make us want to do something.
And this isn't just for stocks, right? Bonds fluctuate too.
Absolutely. People sometimes forget that. Even really high-quality, long-term bonds can see their prices swing quite a bit, mainly due to changes in interest rates. We saw huge swings in bond yields and therefore prices between the 40s and 1970, for example. That mechanical discipline helps there too.
So wrapping this up, the main takeaway is that market quotes, they're just there for your convenience. You can use them when they offer a good deal, or you can completely ignore them. The goal is just don't get scared into selling low or overly excited into buying high.
Right. Avoid being stampeded by the crowd or getting unduly worried by temporary dips. And there's a final kind of provocative thought from the source material. It says an investor who lets market declines worry them too much is basically perversely transforming his basic advantage into a basic disadvantage.
That basic advantage being the freedom not to sell.
Exactly. So think about this. Would you actually be better off, maybe even mentally healthier, if your stocks didn't have a daily market quote at all? If you were freed from the constant noise and the mental anguish caused by other people's sometimes flawed judgments reflected in those prices?
Something to definitely ponder the next time Mr. Market shows up with a crazy offer. Thanks for that deep dive.
My pleasure. Welcome to the Deep Dive. Today, we're going to dig into investment funds. You know, mutual funds, closed-end funds, the whole deal. We're looking for the best path for the defensive investor, trying to cut through that, well, bewildering variety out there. Our goal, simple, really. Avoid the funds likely to give you bad results and find the genuinely smart choices.
Okay, so just to lay out the basics quickly for you. First up are open-end funds. Most people know these as mutual funds. With these, you can redeem your shares whenever you want directly from the fund at what's called the net asset value, or NAV. That's the actual value of everything the fund holds per share. And they're always selling new shares.
Okay, open-end. Got it.
Then you've got closed-end funds. These are different. They don't redeem shares. They issue a fixed number of shares initially, and then those shares just trade between investors on the stock exchange, like regular stocks.
Right, like buying shares of Apple or something.
Pretty much. And the other key thing is the load versus no-load distinction. Load funds, they tack on a sales charge. It used to be as high as maybe 9%. Now it's often capped lower, maybe 5.75%.
Ouch.
Yeah. Whereas no-load funds, they don't have that upfront sales charge. They make their money just from the ongoing management fees.
Okay, so that's the landscape. Now, what's really crucial, I think, is looking at the big picture, the performance overall. I mean, the fund industry, sure, it helps people save, build good habits, maybe avoid some big individual mistakes. That's useful. But the numbers show that actively managed funds as a whole group haven't really done better than the general market, like the S&P 500 index.
Exactly. And that's why this whole performance fund cult thing is just so dangerous. We see it again and again, in market bubbles. These really aggressive funds, they post these spectacular, almost unbelievable gains for a short time.
Yeah, late 90s, late 60s.
Right. And then almost inevitably, it's followed by just calamitous losses when things turn.
That success always feels kind of thin, doesn't it? And the experts, the financial scholars, they pretty much all agree on this. Chasing those funds with amazing past returns, it's very unlikely to make you a winner going forward.
There's data on this. That crash and burn club idea really highlights it. Take Van Wagoner Emerging Growth, a super hot fund in 1999. If you'd put $10,000 in then, well, by 2002, that investment was worth just $4,419.
Yeah, that's brutal. Performance chasing really can destroy wealth. So why? Why does that performance fade so reliably?
Well, there are structural reasons. First, it's the high costs. Think about it. Your typical actively managed fund might charge, say, 1.5% in operating expenses, plus their trading cost, buying and selling stocks, can average another 2%.
Okay.
So add that up. That fund has to beat the market by a whopping 3.5% before any of those costs are taken out, just to end up matching the market after costs. That's a huge hurdle.
Right. A 3.5% headwind from the start. What's the second big issue?
That would be asset elephantiasis. Kind of a funny name, but it's a real problem. When a fund does really well, money just pours in, right? Huge amounts of cash.
Everyone wants a piece of the action.
Exactly.
Right.
But now the manager has this massive pile of cash. They might be forced to buy stocks that are already expensive, or maybe start buying into companies they haven't researched as deeply, or they just have too many stocks to follow properly. It spreads their attention too thin, and performance suffers. It gets diluted.
Asset growth becomes its own enemy.
Okay.
And the third factor?
Simple turnover. Manager migration. A fund manager gets that reputation, the Midas touch, Well, they become a hot commodity. Other firms want them, they offer them huge deals, and poach them.
Ah, so the talent walks out the door.
Precisely. And the original fund is left behind, often lagging the market because the key expertise is gone.
So these structural issues, costs, size, manager turnover, they really stack the deck against active funds.
They do. And that's exactly why index funds have such an almost insurmountable advantage over the long haul. Their costs are rock bottom. We're talking maybe 0.2% for operating expenses, sometimes even less.
Tiny compared to that 1.5% plus trading cost.
Right. It means they get to keep almost everything the market actually earns for their investors. The long-term data is stark. Over a 20-year period, something like fewer than 15% of actively managed U.S. stock funds actually managed to beat a simple index fund like the Vanguard 500.
Fewer than 15%. So if the evidence is that clear-cut, why do so many people still chase active funds and pay those high fees? Is it just trying to be clever? The thrill of the chase?
It seems partly that, yeah. The desire to outperform, to pick a winner, which leads to the intelligent choices.
Right.
The data clearly points towards index funds for most people. But if you are going to use investment funds, there's another smart approach. Leverage the closed-end fund discount.
Okay, explain that. How does that give you an edge?
Remember, closed-end funds trade on the market like stocks. Well, sometimes their share price falls below their actual net asset value, the value of the stuff they hold. So the intelligent move is to look for closed-end funds trading at a significant discount, maybe 10% or even 15% below their NAV.
Ah, so you're buying $1's worth of assets for, say, 85 or 90 cents.
Exactly. Compare that to paying a 5% or even 9% premium or sales load for an open-end mutual fund where you pay more than the asset value. Getting that initial discount gives you roughly, a fifth more underlying value for your money right from day one.
That makes sense, a built-in advantage.
And while discounts can widen sometimes, it's statistically very unlikely that over the long run, a widening discount would completely wipe out the substantial head start you get from buying at that initial discount compared to a similar mutual fund.
Okay, so boiling it all down, the key takeaways seem pretty clear. First, stop chasing yesterday's winners. That performance rarely lasts. Second, focus relentlessly on cost. Lower costs, especially with the index funds, mean you keep more of the return. And third, if you're looking at funds, consider closed-end funds when you can buy them at a meaningful discount to their actual value. Leverage that price advantage.
That covers the mechanics, absolutely. But you touched on the human element, the chemistry, and that's huge. Look, fund performance can lag just because a certain style of investing goes out of fashion for a while. That happens. But one study found that investors in funds actually underperformed the very funds they owned by something like 4.7 percentage points a year.
Wow. By doing the exact wrong thing. Buying high when the fund was popular and doing well, and then panicking and selling low when things got rough. So here's the final thought. If you're not mentally prepared to stick with an investment fund through, say, at least 3 years where it might underperform or go nowhere, then you probably shouldn't buy it to begin with, because ultimately, patience is probably the most powerful ally you have as an investor. More than timing, more than picking the absolute perfect fund. Just imagine patience.
Welcome to the deep dive. We're jumping into a really interesting set of sources today. It's all about getting investment advice. Our mission here is to kind of square up the expectations investors often have versus, well, the reality of what advisors and brokers can actually deliver.
Yeah, and it's fascinating right off the bat because asking for investment advice is unique. You're essentially asking someone else, how do I make money?
Exactly.
No.
You wouldn't ask your lawyer that or your accountant. You expect competence, compliance maybe, but not riches.
Right. And that basic assumption, that maybe naive assumption, sets up this potential mismatch.
So good advice, realistic advice should probably focus on protecting you, right? Making sure you get sort of standard results, avoiding big losses.
Precisely. It's when you start demanding, or maybe the advisor starts promising much more than average returns. That's where the trouble starts.
Okay, so who is actually giving this advice? The sources paint a picture of a pretty messy landscape.
It really is. I mean, one source mentioned that something like 17% of investors lean heavily on friends or family.
Wow, 17%. Compared to only, what, 2% relying on their banker? That seems kind of random for such important decisions.
It's very unsystematic. Now, compare that to the really professional investment counsel firms, the big established ones.
Ah, right. The ones that often need you to have significant assets to even get in the door. Like $1 million or more. Something.
Exactly. And what's interesting is how modest they tend to be in their promises.
They're not promising to double your money every year.
No, far from it. Their main job, as the sources point out, is usually conserving the principal, protecting what you have, and generating a, let's say, conservatively acceptable income.
So their biggest value might just be stopping the client from doing something foolish.
Often, yes. Shielding them from costly mistakes, maybe panic selling, market noise. But the implication is clear. That kind of steady, conservative hand-holding isn't easily accessible for everyone.
Which leads us straight into the brokerage world, and there's a built-in tension there, isn't there?
Oh, definitely. The commission structure? Brokerages make money when you trade. More trading equals more commissions.
So their whole operation is kind of geared towards activity, towards transactions, often short-term ones.
Right. And one source put it quite starkly in speculation, customers are condemned almost by mathematical law to lose in the end, mostly because of costs and the difficulty of consistently timing the market.
And this affects everyone inside the firm, even the skilled analysts, maybe the CFAs.
Yeah, even competent analysts face pressure. They might be great at valuing a company, but they often have to wear a second hat, the market analyst hat.
Meaning they have to predict short-term price moves.
Exactly. They end up analyzing stocks with one eye on the stock ticker, as one source said.
Yeah.
Less focus on true long-term value, more on, will this pop next quarter?
Almost like betting on the next game instead of owning the team?
That's a good analogy. Now, we also need to briefly touch on safety. History gives us a warning sign here.
You mean the issues back in the late 60s?
Yeah, when some brokerage houses got into trouble, partly because partners were speculating with the firm's capital, the money meant to safeguard customer accounts.
So the recommendation was for average investors not using margin.
Right. If you're not borrowing to invest, consider having your transactions settled through your bank. Just an added layer of safety until you're sure everything's solid.
Okay, so shifting gears slightly. When do you, the listener, know you might actually need professional help? What are the signals?
Well, the sources list a few clear ones. If you've suffered really big losses, like, say, losing 40% or more in a downturn like 2000, 2002.
Ouch. Or if your budget is constantly busted, maybe. Or your portfolio is just a mess.
Exactly, like owning, quote, 39 different internet stocks and thinking you're diversified. That's a sign you need structure.
So if you see those signs and decide to look for help, due diligence is absolutely key. The mantra is trust, then verify.
Absolutely critical. You have to check their background. Look for complaints online, check with regulators, your state securities commissioner, the CFP board, perhaps.
And demand their Form ADV, right.
Mm.
What is that exactly?
It's the registration form advisors file. Crucially, you want the disclosure reporting pages. That's where any past disciplinary actions, lawsuits, bankruptcies, it all has to be listed there.
Got it. And then there's the language they use. Certain phrases should be huge red flag.
Oh, yeah. Instant deal breakers. If you hear things like guaranteed or opportunity of a lifetime.
The sure thing.
Or we can beat the market. Everyone's getting in on this. And the absolute classic. Trust me, if you hear that, just walk away. Politely but quickly.
Okay, so during the actual interview, what key questions should you ask?
Definitely ask about their investing philosophy. If they talk a lot about market timing or chasing short-term trends, that's often a warning sign.
What about how they get paid?
Crucial.
Oh.
Ask if they accept third-party compensation, like commissions for selling certain products, and ask point blank what they think a feasible annual return is.
And the sources suggest anything over, say, 8 to 10% consistently is probably unrealistic bait.
Generally, yes. Be very wary of promises significantly higher than that. And finally, fees. Keep a close eye on total costs. They shouldn't really eat up more than, say, 1% of your assets each year.
So wrapping this all up, what's the big picture? What's the ultimate role of a good advisor?
Well, it boils down to this. Maybe their best value isn't actually managing the money itself. It's managing you.
Protecting you from yourself. From panic, greed, making impulsive decisions?
Precisely, helping you stick to a sensible plan.
Okay, so here's a final thought for you to chew on. A good advisor should help you put systems in place, right? A proper financial plan, an asset allocation strategy, maybe a written investment policy statement.
Yeah, those foundational documents that guide decisions.
So if an advisor doesn't focus on building those systems with you, how can you really expect help in defeating your own worst enemy, which is often just your own emotional reactions? Welcome back to the Deep Dive. Today we're taking a bit of a shortcut, really, straight into the bedrock of investing security analysis. We're going to try and distill the key methods and, the serious warnings from some foundational financial text, stuff for the non-professional investor. But maybe first, let's just nail down the scope. Because security analysis, it's quite focused, right? Just on specific stocks and bonds.
Exactly. It's distinct from financial analysis, which is much broader. That covers portfolio strategy, market timing, all sorts of things. Security analysis is narrower. The security analyst's role is, well, it's pretty active. They're not just describing the business or summarizing past results. They have to lay out the risks, estimate future earnings, that's a big one, and critically, they often need to modify the company's own figures.
Modify them, even if they're certified by accountants.
Oh, absolutely. You have to be the skeptic. Even with audited numbers, the analyst needs to look deeper.
Okay, skepticism. Got it. But here's this paradox you mentioned right at the start of the source material. The more sort of mathematical the valuation technique gets, the less reliable it often turns out to be, especially if it leans heavily on, like, the distant future.
That's the core warning sign, yeah. It's like when analysts start wheeling out higher algebra or, complex calculus to justify a stock price. Well, you should probably see that as an attempt to swap fancy theory for actual grounded experience.
Okay, let's unpack this. So if complex math is suspect, where do we find reliability?
Well, the most dependable area traditionally is bond analysis. Much more straightforward in some ways. The main thing there is coverage. Simple concept, really. How many times have the company's earnings covered its fixed charges, like interest payments, over the years?
Right, the interest coverage ratio. And the standard mentioned is pretty demanding, isn't it? For an industrial bond to be investment grade, earnings should cover fixed charges 7 times over, on average, for 7 years before taxes.
7 times, yes. It sounds incredibly strict, I know.
Yeah, are we just leaving money on the table being that cautious?
What's fascinating here is the evidence shows it's not just about being cautious, it's about survival. Passing really stringent tests based on past performance has historically been the best predictor of future safety for bonds. It works.
So past performance is key for bonds, a big safety margin. But stocks are all about the future, aren't they? How do we handle that switch?
That's the tricky part. That's the pivot, like you said. I mean, theoretically, the ideal way to value a common stock is estimate its average future earnings and then multiply that by some appropriate capitalization factor, basically a PE ratio.
But estimating future earnings, that feels like where the wheels come off, right? That's guesswork territory.
It certainly can be. Graham specifically warned about this. Dependable calculations for stock value shouldn't really go beyond simple arithmetic. The moment you rely too heavily on projecting growth rates far into the future, even tiny errors in your projection can completely wreck your valuation. Keep it simple.
Okay, here's where it gets really interesting. Let's apply that skepticism to the PE ratio itself, what actually justifies a high PE multiple. The sources pointed to a couple of big factors. First, general long-term prospects. But the warning was stark. Wall Street's consensus is often wrong. Like that example from '63, where everyone loved chemical stocks over oil stocks.
Right, and by 1970, the oils had crushed the chemicals. The market consensus blew it. So you can't just trust the herd's view of the future. And the second factor, maybe even more vital, is management quality and conduct.
Ah, yes. And there were some practical red flags for listeners here, like OPM addicts.
Yeah, OPM addicts other people's money. Companies that consistently show negative cash flow from their actual operations.
Yeah.
And they're just surviving by constantly raising money through financing, selling stock, taking on debt, borrowing from the future, essentially. Big red flag.
And the other one was behavioral, wasn't it? Companies repricing stock options for insiders if the share price drops.
Exactly. It basically means management gets rewarded even if shareholders are losing money. It shears the investor, as the text put it, a definite warning sign about management alignment.
Okay, so watch the management. Now, what about growth stocks? They seem to defy simple PE analysis.
Well, analysts use complex models, but Graham offered a sort of shortcut formula designed to approximate those complex models without the black box feel. It was value equals current earnings times. Wait for it. 8.5 plus twice the expected annual growth rate.
Huh. 8.5 plus 2 times the growth rate.
Yeah. And what's really clever is you can flip it around. You can look at a stock's current price and use the formula to see what growth rate the market must be assuming to justify that price. Like with Xerox back in '63, its price implied this incredibly high, basically impossible growth rate continuing for years. It showed the market price was pure speculation, not investment.
So the formula reveals the hidden assumption. Clever.
And underpinning all of this, don't forget basic financial strength and capital structure. It's non-negotiable.
Right, the structural safety net.
A good rule of thumb. Keep long-term debt, ideally under 50% of the total capital. Too much debt just adds too much risk.
So what does this all mean if we try to tie this together for you listening?
I think it means sound analysis has to anchor itself in objective, measurable past results first. You start there, and only then do you carefully, cautiously layer on some disciplined expectations about the future.
So the past provides the anchor, the future is just a potential modifier.
Precisely. The moment the future, the forecast, becomes the main driver of your valuation, you've probably crossed the line from investing into speculating.
Okay, so here's a final thought, maybe something provocative for you to consider. This whole analysis suggests a kind of two-part appraisal process. Step 1, calculate a purely mechanical past performance value, based only on the historical record. No future guesses yet.
And then, step 2, deliberately modify that backward-looking value based on your reasoned, conservative expectations for the future.
Could adopting that kind of strict two-stage approach, could that lead you to more disciplined, maybe more reliable investment decisions? Something to think about.
All right, let's unpack this. Our mission today, really, is to help you sidestep some of those financial booby traps, the ones hidden deep inside reported corporate earnings.
Right, because you hear these contradictory things, don't you?
Exactly. First, people say, ignore the short-term results, don't sweat 1 year's earnings.
Uh-huh.
But then the advice is, well, if you do look at them, you have to be incredibly careful, especially with those per-share figures.
That's tricky. If you just ignore the short term, you miss some, well, frankly, some pretty clever engineering in those reports.
Clever engineering, I like that.
Yeah. Take the Aluminum Company of America, ALCOA, back in 1970, just to show the kind of confusion we're talking about.
Yeah.
Their main published number was share earnings of $5.20.
Okay. Sounds decent on the surface, $5.20.
Sure, but then you dig in, and the footnotes explaining how they got that $5.20, they took up twice the space of the actual numbers.
Twice the space. That's a lot of explaining.
It is. And it turns out, LCOA actually put out 4 different earnings figures for 1970. 4. The lowest was $4.19 per share, after all the adjustments and special charges.
No, quite a range from $5.20 down to $4.19.
But here's the kicker. If an investor just looked at their really terrible December quarter number, just $0.70 net income, and then annualize that.
Uh-oh.
Yeah. The stock's price-to-earnings ratio, the PE, it jumps instantly from what looked like a cheap 10 times earnings based on the $5.20.
All the way up to?
All the way up to 22 times earnings. Just by using that one less flattering quarterly figure, it more than doubles the valuation.
Okay, so understanding the adjustments is obviously key. Let's start with maybe the simplest one, dilution. How much impact can just counting shares differently really have?
Oh, a huge impact. LCOA's number went from $5.20 down to $5.01 just from this. That lower figure reflects fully diluted earnings.
Fully diluted, meaning?
Meaning the calculation assumes that things like convertible bonds, stock options, warrants, they'll all eventually be turned into actual shares. So you divide the earnings by a larger number of shares.
Ah, okay. More shares, so less earnings per share.
Exactly. And for some companies, especially, high-growth tech firms back in the day, that could cut the reported earnings per share in half, or even more sometimes.
Half. Okay. But the real, let's call it artistry, seems to come with these special charges. Cleaning the slate, as you put it.
That's where it gets really interesting. LCOA took off 88 cents a share for what they called management's estimates of future costs.
Future costs? Like what?
Things like closing down plants later on, phasing out divisions, expected losses on contracts that hadn't even fully played out yet.
So wait, they're deducting costs today that haven't actually happened yet?
Precisely. And that's the ingenious trick. You charge off these future losses in a year that's already bad, like 1970 was for LCO. So the argument is, these costs don't really belong in 1970 because they haven't happened. But crucially, they also won't show up as expenses in future years when they do happen because you've already accounted for them back here.
Oh, I see. So it makes future years look artificially better. It fattens up the profits later on.
You got it. It's like that old sundial King Edward VII that supposedly had, the one that only counted the sunny hours. Companies want to count the sunny hours too.
But shouldn't some failure be normal for a big company? Plants close, divisions get phased out. Why let them call it extraordinary and pull it out of regular operating costs?
Well, often it's about managing perceptions, painting a smoother picture for the coming years. And sometimes these big write-offs can even generate tax credits that boost future reported profits. It sets the stage for some more modern games. Remember what Bo Diddley said?
Remind me.
You can get ripped off easier by a dude with a pen than you can by a dude with a gun. The accounting pen can be pretty mighty.
Which brings us to today's perhaps most common trick, pro forma statements, the as-if earnings.
Oh yeah, the pro formas.
Yeah.
These are basically financial fairy tales. Companies like InfoSpace or JDS Uniphase became famous for this.
How did they work?
They'd release these statements showing what they would have earned if huge, very real expenses hadn't actually happened. Things like payroll taxes on stock options people cashed in, or big charges for mergers, all just wished away.
So what's the advice for investors seeing those?
Simple advice: ignore them completely. The intelligent investor looks at the real numbers, the GAAP numbers, not the as-if fantasy.
Okay. Another one you mentioned is capital offenses, redefining expenses.
Right. Global Crossing was a classic example. They started something called service contract accounting. Sounds innocent enough?
But it wasn't.
No. It let them take costs for building their network stuff that really should have been an operating expense, paid right away, and instead classify it as a long-term capital asset, like building a factory.
So instead of an expense hitting the income statement now, it becomes an asset on the balance sheet.
Exactly. It magically lowered their reported expenses, inflated their assets, and boom, you create the illusion of profitability just by changing an accounting definition.
It's a minefield out there.
Yeah.
So for the listener, what's the defense strategy? Caveat investor, right? Buyer beware.
Definitely. 2 quick tips. First, try reading the financial reports backwards.
Backwards, like start from the last page.
Yeah, seriously. Companies often bury the stuff they really don't want you to focus on deep in the back, in the footnotes, the management discussion section. Start there.
Interesting tactic. Okay, and second.
Second, pay very close attention to the section usually called the Summary of Significant Accounting Policies. It's often near the beginning of the footnotes.
What are we looking for there?
Your ears should prick up when you see technical words like capitalized, deferred, or restructuring, or even just simple English words that signal a change. Words like began, change, or the classic, however, they often signal a shift in how they're counting things.
Got it. Read backwards and watch the accounting policy language.
Fundamentally, given how complex and, frankly, tricky corporate accounting can be, maybe the focus shouldn't be on trusting any single published earnings number.
So what should it be then?
It should be more about assuring yourself that you're getting good, solid, long-term value for the price you're paying for the stock overall. Don't get lost chasing one magic number.
That makes sense. Okay, let's leave our listeners with a final thought to chew on. You brought up the Northwest Industries case earlier. They had this huge $264 million write-off, right? A real financial disaster from the past.
That's right, a massive loss.
But paradoxically, because of tax rules, that huge past loss allowed them to earn something like $400 million in future profits, completely tax-free. The loss created tax credits.
Yes, a strange benefit from a past failure.
So here's the question for you, the listener. If a company's terrible past performance can somehow lead to this very fine profits appearance, as the source material puts it, in the future just because of tax breaks, how do you fundamentally value that company? How much weight do you give its actual ongoing earning power versus this temporary tax advantage status? That's the real challenge, isn't it? Something to think about.
Welcome to the Deep Dive. Today we're tackling, well, a classic question, but one that still trips up investors. When you pay top dollar for those glamour stocks, the ones everyone's excited about, are you actually buying future success?
Right.
Or just setting yourself up for a big loss?
Exactly. And we've got some great source material to explore this. We're looking at two sets of companies analyzed decades apart. One group from the 1970s and another right from the peak of the dot-com madness in 1999.
And the goal here is to see if that buzz, that investor excitement, actually lines up with, decent long-term results.
Right. Does paying more get you more in the end or less?
Okay, so let's start back in the 70s. Graham looked at four companies, LTRA, Emhart Core, Emerson Electric, and Emery Air Freight. Industrial firms, mostly. What stood out?
Well, the valuations were just miles apart. You had LTRA and Emhart classic value stocks, pretty modestly priced, maybe 10, 12 times average earnings. And crucially, they were trading near their tangible book value. So the price had some grounding in actual physical assets. A bit of a safety net, you could say.
Okay, makes sense. But then you had the others, the glamour one.
Oh, yeah. Emerson Electric was higher, but Emery Air Freight was the real high flyer, trading at something like 45 times earnings.
45 times earnings for an air freight company. Back then, wow, that seems excessive. How did Graham view that?
He was definitely skeptical. I mean, Emery had shown impressive growth before, sure. But 45 times earnings, he basically concluded the value stocks, LTRA, and Emhart were reasonably protected investments.
And Emery?
Priced for perfection and maybe more. And, well, history proved him right. By 1982, after inflation, Emery's stock had lost, get this, 72.8% of its value.
Ouch, a total wipeout. Just textbook overenthusiasm paying off badly.
Precisely. Paying way too much for growth that didn't fully materialize or couldn't possibly justify that price.
Okay, so lesson learned in the 70s. Maybe. Let's fast forward. Year-end 1999, dot-com bubble peak. Different companies, but is it the same story? We've got Emerson Electric again versus EMC Corp, Expeditors International, and Exodus Communications.
Right. And it's an even starker contrast this time, I think. Emerson, the survivor from the first group, is now the reliable giant. PE around 17, 18. Solid.
Inconsistent. Right. Didn't they have some crazy streaks?
Unbelievable streaks. Increased earnings for 42 years straight, raised dividends for 43 years straight. Just utterly dependable.
Okay, dependability versus EMC Core. The absolute darling of the late 90s tech boom.
An ultimate glamour stock. An 81,000% return in the 90s. Think about that. And by the end of 99, its PE ratio was 103 times earnings.
103. So what were people actually buying there? Just momentum?
Pretty much. They were buying the story. And here's a really critical piece we found digging into the numbers. Yeah, EMC's total revenue grew 24% that year, which sounds great.
Yeah.
But the analysis showed that the actual volume, the organic growth of their existing businesses, it only grew about 3.6%. Most of that growth, everyone was cheering. Acquisitions.
Ah, so using M&A to keep the growth numbers looking high, even if the core business was slowing. That's a classic red flag, isn't it?
Absolutely. Hidden in plain sight, really, because the hype is just so loud.
And if EMC was hype, what was Exodus Communications? That sounds even more extreme.
Oh, Exodus was pure speculation territory. I mean, look at the fundamentals. They were losing $130 million on $242 million in revenue, drowning in debt.
But the stock was flying high. Didn't it split multiple times?
Yeah, 3 times in 1999 alone. And the market loved it. It was pure psychology. People felt richer seeing more shares in their accounts, like having 2 nickels was somehow better than 1 dime. The actual value, the company's health, almost irrelevant in the frenzy.
Okay, so the stage is set. The reliable versus the hype and the hyper-speculative. Let's get the final scorecard. What happened from the end of 1999 through the bubble bursting in 2002?
Well, the boring stocks did okay. Emerson and Expeditors International, they basically held their value or even gained. Expeditors was up about 51% over that period.
Pretty good through a crash. And the glamour stocks.
Predictably, they followed the path of Emory Air Freight from the 70s. EMC, the PE 103 darling, lost 88% of its value.
88% gone. And Exodus.
Total disaster. Filed for Chapter 11 bankruptcy. Wiped out.
So the pattern is just incredibly consistent across decades, isn't it? Paying way, way too much upfront for growth means that growth has to be absolutely stellar, even better than expected, just for you to break even, let alone make money.
That's the core lesson. You're essentially paying for perfection, and perfection rarely happens, especially over the long term. Any slip-up, any slowdown, and that high price becomes an anchor.
Which really brings us to the final thought for you, the listener. We see this pattern repeat: value versus glamour, measured expectations versus pure hype. The long-term results consistently favor caution, favor value.
Right. Yet the market still gets swept up in these manias. We still see companies trading at astronomical multiples based largely on momentum or narrative. So the question is, why? What is it about market psychology or maybe human nature that makes us repeatedly ignore these historical lessons and overpay for glamour, knowing the potential downside?
Something definitely worth thinking about next time you see a stock that just feels a little too hyped. Okay, welcome. Today, we're really opening up the playbook for building a solid financial foundation. We're diving deep into the specific rules for the defensive investor. That's the kind of person, who prioritizes safety, wants to keep things relatively simple, and relies on hard facts, not just hunches.
Exactly. And the core task for this investor really boils down to stock selection. There are basically 2 main paths laid out. Path 1 is definitely the simplest. Just get a broad cross-section of the market. Today, that pretty much means grabbing a low-cost index fund that mirrors the whole market.
Okay, hang on. If the index fund is the easy, safe bet, why would anyone even consider the second path? You mentioned this quantitatively tested portfolio. That sounds like a lot more work picking individual stocks based on strict rules. What's the payoff?
Well, the potential reward is getting a margin of safety that you can actually verify quantitatively. If you do decide to step beyond just the index fund, you absolutely must apply these tests. They're designed to make sure you're getting both quality, a solid company, and real value. That means enough earnings and assets behind each dollar you invest, giving you that protection against big losses.
Makes sense. So let's zoom in on those specifics then. These 7 criteria, you're saying they act like a filter, right? Screening out most stocks because they're either too risky or, just too expensive.
Precisely. They tackle both risk and price. The first rule is just adequate size. We want to avoid very small companies. They can be much more volatile, so there's a minimum floor set. $100 million in annual sales for industrial firms. Or for public utilities, it's $50 million in total assets.
Got it. Size matters for stability. Then we get to what sounds like a tougher one: strong financial condition. For industrial companies, current assets need to be double current liabilities. A 2.1 ratio. That sounds demanding.
It is. That's the immediate safety net. But the really stringent part, it's that long-term debt cannot be more than the company's net current assets. Net current assets is just current assets minus current liabilities, often called working capital. This rule basically insists the company isn't funding its long-term operations by dipping into the cash it needs day to day. It's a strong check against liquidity problems.
Okay, so first size, then financial strength right now. Let's shift gears to track record. The next few rules look back, right?
That's right. History matters here. Rule 3 is earnings stability. It requires some positive earnings for the common stock in every single one of the past 10 years. No losses allowed in that decade. And Rule 4, the dividend record. This one's tough. Continuous dividend payments for at least the last 20 years.
Wow, 20 years of uninterrupted dividends. That's quite a hurdle. Doesn't that automatically exclude almost all younger, fast-growing companies, even if they're profitable now, maybe tech companies? Is it too focused on the past?
For the defensive investor, that's actually the point. It's a feature, not a bug, you could say. This strategy isn't trying to guess who the next big thing will be. It's focused on proven, reliable, long-term survivors. And Rule 5 reinforces that historical view. Earnings growth. We need to see at least a 1/3 cumulative increase in per-share earnings over the last 10 years. We use 3-year averages at the beginning and end to smooth things out, you know. It filters out companies that have been going backward over the long haul.
Okay, quality and history are covered. Now, the final piece? Price. We found good companies, but we can't overpay. Rule 6 tackles this with the moderate price-earnings ratio, or PE. Price shouldn't be more than 15 times the average earnings from the past 3 years.
Correct. 15 times is the limit there. And Rule 7 brings in the balance sheet. Moderate ratio of price to assets, or PB. The price shouldn't be more than 1.5 times the company's book value. Book value, for anyone unfamiliar, is roughly what would be left for shareholders if the company sold all its assets and paid off all its debts. It's a measure of net worth on paper.
Right. And then comes the master check, you call it, the product of the PE ratio, and the PB ratio can't go over 22.5.
Oh.
How does that number work as the final safeguard?
It forces a trade-off, essentially. It keeps things balanced. You see, you could maybe pay a slightly higher PE, say 18, if the price to book is really low, like 1.0, because 18 times 1.0 is 18, which is less than 22.5. Or maybe you could pay a bit more relative to book value, say 1.8 times if the PE is very low, maybe 10, because 10 times 1.8 is 18, still under 22.5. But you can't have both a high PE and a high PB. It prevents you from overpaying on both metrics simultaneously. And this really ties back to the core philosophy, you know. These rules are all about protection. They rely on what's measurable now, the margin of safety, and current earnings and assets. The moment you start focusing heavily on prediction guessing about amazing future growth, you're moving away from this defensive stance and more into, well, speculation.
That's a clear distinction. And you mentioned utilities earlier. How do they fit into this picture historically?
Yes. Utilities, for a long time, were often a simpler area for the defensive investor. Because they were typically regulated monopolies, a lot of them consistently met these kinds of performance and financial criteria. And importantly, their prices often stayed closer to their book value, making it easier to find qualifying stocks in that sector.
So wrapping this up, what's the key takeaway for someone listening?
Well, these 7 criteria are tools. They help you find companies that are built to last, conservatively financed. Even if you decide, wisely perhaps, to put most of your money, say 90%, into broad index funds, understanding these standards is really crucial, especially if you want to take that remaining 10% and try your hand at picking some individual stocks defensively. These rules give you a framework.
Okay, and a final thought for everyone to chew on. Something a bit provocative. Think about this. If you were absolutely certain you could pick the single best performing stock year after year, why would you ever need to diversify? Diversification, in a way, is admitting the limits of stock picking. It's like saying nobody can really know for sure which stock is the best. Because the moment everyone agrees a stock is the best, its price instantly jumps up, erasing that supposed advantage. It highlights the challenge, maybe the impossibility, of consistently beating the market through sheer predictive brilliance. Something to consider.
Welcome to the Deep Dive. Today is all about you, the enterprising investor, the one who wants to actively pick stocks and, well, beat the market average.
Which, let's be honest, is a really tough gig.
It absolutely is. A very high bar. We've got some sources today detailing some highly specific, maybe even non-traditional ways to find those undervalued gems.
Yeah, and what's fascinating right off the bat is how often even the top pros fail at this. It's kind of staggering.
Tell me about it.
Well, there were these studies back in the 70s, like the one by Friend, Bloom, and Crockett. Really groundbreaking stuff.
Okay.
They found that on average, these big all-common stock funds, run by really smart people.
Right, the highly paid manager.
Exactly. They actually failed to match the S&P 500. They basically underperformed by, get this, the amount of their own operating expenses.
Wow. So they picked stocks, charged fees, and ended up behind the simple average just because of those fees.
Pretty much. It raises the question of why this happens, right?
Yeah, I mean, if the pros can't do it consistently, why should anyone else even try? Does it just mean the market's totally random?
Well, it could be one of two things, or maybe a mix. One idea is the market is pretty efficient, reflecting known facts, making future moves hard to predict.
Okay, the efficient market hypothesis.
Sort of. Or the other issue is analysts get distracted. They focus too much on, predicting amazing future growth.
Chasing the next big thing.
Yeah, and they end up paying basically any price for that popular story instead of looking at the solid, maybe boring value right in front of them.
Okay, so against that backdrop of professional struggle, let's pivot. Let's talk about Benjamin Graham's approach, the Gray-Mooman methods that actually did produce results by looking where Wall Street wasn't.
Exactly. Graham wasn't chasing glamour. He looked for mathematically sound, almost self-evident value. Two key methods stand out.
All right, let's hear them.
First was what he called net current asset issues, or simply bargain issues.
Bargain issues. I like the sound of that.
Yeah, it means buying a stock for less than its value in net current assets alone. That's cash, receivables, inventory, minus all liabilities.
Wait, so you're saying you ignored the factory, the machines, the brand, all the long-term stuff?
You give it zero value in this calculation. Zero. You're buying the liquid assets for less than they're worth on the books.
That seems incredible, like finding money on the street.
He aimed to buy at 2/3 or less of that stripped-down value. Historically, it worked remarkably well. Very dependable.
But does that opportunity still exist? And aren't those companies often, falling apart? What's the catch?
That's the challenge. Opportunities can dry up in strong markets. And yes, some might be declining. The risk is poor management squandering those current assets, which leads to a second area.
Okay.
Special situations or workouts. This is more for the pros, usually. It involves things like arbitrages in mergers or reorganizations.
Trying to capture the small spread between prices when one company buys another.
Exactly. Aiming for maybe a 20% annual return, often based on the deal closing, not on general market moves. Also liquidations, buying shares, expecting a cash payout as a company dissolves.
Sounds complex. And risky, I imagine, if a merger falls through.
Definitely risky.
Yeah.
Deals collapse. But for the individual investor looking for something more practical, Graham also gave us screening criteria.
Right, actionable steps.
Yeah, using basic stock guides. He'd start with a low PE ratio, maybe 9 or less back then. But crucially, that was just the start.
Well.
Stringent financial checks, things like solid earning stability over years, a strong current ratio, and tying back to assets, maybe requiring the price to be less than 120% of net tangible assets.
So a multi-factor check, not just one simple metric.
Absolutely. Now, connecting this to today, modern value investors, guys like William Nygren, Christopher Davis, they adapt this philosophy.
How so? What's the modern twist?
They still look for the unpopular, the unfashionable. A great place they often look, the daily list of 52-week lows.
The stocks everyone else hates right now.
The unloved, the ignored. Stocks may be under a temporary cloud, but where the underlying value might still be strong. That's often where the best potential lies.
And in terms of measuring the company's health, I know there's been a shift from just earnings per share, right?
Big shift.
Yeah.
Towards ROIC, return on invested capital.
Explain that one quickly.
It basically asks, how much profit does the company generate for every dollar of capital tied up in the business, both debt and equity? It shows true operational efficiency.
And what's a good number there?
You'd ideally like to see 10% or more. That shows management is using shareholder money really effectively.
Which brings up management itself. How important is who is running the company?
Hugely important. Successful investors look for managers who genuinely think and act like owners, not just hired hands.
What does that look like in practice?
Candor. Clear communication about the business, not just hype. And critically, managers who own significant amounts of stock themselves, bought with their own cash. Ideally, not just handed options. They ignore guys who just talk constantly about the stock price.
Right. You want their interests aligned with yours as a shareholder. Owners, not just renters running the place.
Precisely.
Okay, so we want good managers in efficient businesses. But what if you have a brilliant manager stuck in a fundamentally terrible industry or business structure?
Well, that leads to the wrap-up. Ultimately, successful investing seems to boil down to two key traits. First, discipline and consistency. Sticking to your sound approach, even when it's out of favor.
And second,
Paying very little attention to the day-to-day noise of the market. Detachment.
discipline and detachment. Got it. And maybe a final thought for you, the enterprising investor, to chew on.
Yeah, consider something Warren Buffett famously observed about reputation. He said, when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact.
Meaning the underlying business quality usually wins out over temporary management skill.
That's the implication. It really emphasizes focusing on the fundamental economics of the business itself, perhaps even before you assess the managers. Think first about the business. Welcome to the Deep Dive. Today we're digging into two pretty complex financial instruments, convertible issues, that's bonds and preferred stocks, and also stock option warrants.
Right.
And our sources, well, they take a very skeptical view. We want to contrast that whole sales pitch with, how these things actually performed historically.
Yeah, and you can see why the sales pitch works, can't you? For convertibles, they really push this idea that you get, well, the best of both worlds, the safety of a bond or preferred stock, but also the chance to profit if the company's common stock takes off.
Okay, let's unpack this. If it's really the best of both worlds, why do our sources basically say it's often a trap?
Well, because you're almost never getting something for nothing, right?
Yeah.
To get that conversion feature, that extra potential upside.
Right.
You typically give something up. Maybe it's a lower yield than a regular bond. Maybe the underlying quality isn't quite as good. The convertible structure itself doesn't make it good or bad. It just makes it complicated.
Yeah.
And usually means compromise.
And timing seems crucial here. The sources really hammer this point that historically, these convertibles tend to flood the market late in a bull run.
Exactly. Just when things are looking rosy, but, a downturn might be around the corner, and that's when they're set up to disappoint.
So is there data on that? How bad was the disappointment?
Oh, yeah. There's a pretty stark example from 1946. New convertible preferreds offered then, they dropped, on average, about 30% to their low point.
30%.
Yeah. But the regular non-convertible preferreds issued around the same time, they only fell about 9%.
Wait a minute. So the very feature sold as offering extra safety actually tripled the downside compared to the standard version.
That's what the historical data suggests for that period. It completely undermines that safety net idea, doesn't it?
It really does.
Okay.
Okay, so what happens if they do go up? You mentioned a dilemma.
Right. Suddenly you have choices. Do you sell the convertible? Do you hold on to it? Or do you actually convert it into common stock? And that's where you hear that old Wall Street saying, never convert a convertible bond.
Never. But isn't that the point? To capture the stock gain.
Well, the thinking is when you convert, you give up that unique position you had, that prior claim from the bond, plus the potential stock gain. You become just another common stockholder, often, right when the stock might be peaking. You lose your safety belt, essentially. You shift from being an investor with a bit of an edge to just speculating.
Okay, so that's the traditional view. Have these things changed? Are modern convertibles different?
Structurally, yes, somewhat. They often have shorter maturities now, more investment grade, so maybe a bit less volatile on the surface. But fundamentally, they still behave much more like stocks than bonds. Recent analysis shows something like an 83% correlation to the S&P 500.
Wow, 83%.
Yeah. Compare that to only about 30% correlation with Treasury bonds. So you get bond language, but you're mostly getting equity risk.
Okay, here's where it gets really interesting. Because the source material uses incredibly strong language about stock option warrants.
Oh, it really does. No punches pulled. They're called things like near fraud, an existing menace, even a potential disaster. That's a pretty intense language for finance.
Definitely not your usual market commentary. It sounds like they think value is being created by, subtraction. How does that harm the regular shareholder?
Basically, the argument is that warrants artificially carve out a piece of value that should belong to the common stock specifically. The preemptive right shareholders sometimes have to buy new shares first. They take that right, package it as a separate thing, the warrant, and sell it. It makes the original stock look maybe a bit cheaper, but part of its inherent value has been siphoned off. It's like selling a car but keeping the engine.
And that separate piece, the warrant, its value can just evaporate.
Dramatically. Look at the American Foreign Power Company warrants back in the day. In 1929, their market value was, get this, over $1 billion.
$1 billion. For just the warrants.
It's just the warrants. By 1932, that value crashed to about $8 million, and eventually they were wiped out entirely in a restructuring. Poof, $1 billion of paper value created seemingly out of thin air, just gone.
That's staggering. So stepping back from these specific examples, what does this all mean for the intelligent investor today?
I think the core message is extreme scrutiny. Both convertibles and warrants, they often come wrapped in complexity and excitement, especially when markets are optimistic.
Right.
But the sources strongly suggest that adding a fancy, complicated feature often betrays an absence of genuine investment quality underneath. It's a warning sign.
And we still see this love for complexity, don't we? All these acronyms for new hybrid securities. I've seen things like LIONS, ELKS, Ps.
Structured notes, all sorts of things.
Right.
Which leads to, I think, a really important final thought.
Okay.
If Wall Street is pitching you some complex product, carefully designed, they say, to protect your downside and capture the upside, What are they assuming you'll forget to check? They're likely counting on you not looking too closely at the trade-offs, at what you're actually giving up in the fine print to get that special feature. Welcome to the deep dive. We've been digging into sources, some going back decades, and honestly, it's kind of shocking how the script for corporate collapse repeats itself.
It really is.
So our mission today is simple. Give you a shortcut, help you recognize 4 classic patterns of financial disaster, warnings that people miss from Penn Central right up to AOL Time Warner.
Yeah, it's this cycle of, well, greed and maybe just not looking closely enough. We've boiled it down to 4 extremes. The tottering giant, the unsound empire builder, the really disproportionate acquisition, and the frankly worthless public offering.
Okay, let's dive in.
So where should we start? Maybe with the most basic thing, something that should be easy to check but somehow gets ignored. Financial safety.
Extreme 1, right. And in the classic case here is Penn Central. Huge company back then, biggest railroad in the U.S.
Absolutely massive.
Stock hit $86.50 in '68, looked great on the surface.
Yeah.
But simple analysis showed, well, red flags everywhere.
Yeah, big time. I mean, look at the interest coverage ratio. Sources point out their earnings covered interest charges less than 2 times.
2 times? Wow.
Yeah, and the safety minimum, the real benchmark, should be about 5 times before taxes.
So what does that actually mean for the company? Less than 2 times.
It means even a small dip in business makes it incredibly hard to just pay their loan interest. Super fragile.
Mm-hmm.
And another thing, they paid almost no income tax for 11 years.
11 years? How is that even possible?
Well, it strongly suggests those reported earnings weren't quite real. Lots of accounting tricks,
Okay, so fast forward. Where did we see this playbook run again more recently? Lucent Technologies, right? Around the dot-com peak.
Oh, Lucent. Perfect example.
Yeah.
Huge valuation, tons of hype, but the fundamentals, shaky. They paid, $4.8 billion for Chromatis Networks?
A company with 0 revenue.
Exactly. And $4.2 billion of that price tag was just booked as goodwill.
Goodwill. Basically valuing hope over reality.
Pretty much. And there was more with Lucent. Remember the loans? They loaned or guaranteed about $1.5 billion to their own customers.
Wait, why is loaning to customers a bad sign? Isn't that just helping sales?
Sometimes. But in this context, the sources suggest it's a sign of distress. It implies the people buying Lucent stuff, well, they couldn't actually afford it without Lucent footing the bill.
Ah, okay. So they're propping up their own sales figures. Unsustainable.
Definitely unsustainable. Clear warning sign. So if ignoring safety is extreme 1, what's next?
Extreme 2. Actively engineering disaster through just head over heels debt and empire building.
Right. The serial acquirer who gets addicted to deals.
Ling Temco Vought, LTV, the classic example. Debt just exploded from $44 million to over $1.8 billion.
No.
And the stock crashed from nearly $170 down to about $7. The lesson is pretty stark. Chasing empire often leads to, well, financial death.
And the modern parallel. Tyco International jumps right out. Dennis Kozlowski. Their whole growth strategy depended on acquisitions, constantly buying companies.
But they hid the true costs, right?
Exactly. They constantly used non-recurring accounting charges, merger costs, write-offs, integration expenses, year after year.
Which kind of proves they weren't non-recurring at all.
Precisely. Yeah. If you spend millions every single year cleaning up after acquisitions, that's not a one-off event. That's a core, predictable cost of your business model. They were just hiding it.
Okay, makes sense. So that brings us to extreme 3, the minnow swallows the whale scenario.
Yeah, where a much smaller company takes over a giant, usually with disastrous results. The historical case is NVF buying Sharon Steel.
Sharon Steel was, what, 7 times bigger?
7 times. And NVF pulled it off using huge amounts of debt and some, let's say, startling accounting devices. It crippled the combined company.
And the big modern version of this has to be AOL Time Warner.
Oh, absolutely, the poster child. Time Warner was massive, 5 times bigger than AOL in assets and revenue.
But AOL ended up in control. How?
Because AOL's stock valuation was just insanely inflated by the dot-com bubble. Pure internet hype. So their funny money bought them 55% control of the merged entity.
And the result was?
The biggest corporate loss ever recorded up to that point. $98.7 billion in 2002. Mostly just writing down the ridiculous value assigned to AOL in the first place.
Unbelievable. Okay, last one. Extreme 4. Hot issues and just pure reckless speculation.
Right. This is where the public really gets caught up. The classic example, AAA Enterprises in the late 60s.
What was their magic?
The magic word was franchising. They went public at $13, stock doubled almost instantly to $28.
Based on what?
Hype. It was trading at 115 times earnings. And surprise, surprise, bankrupt within 2 years.
The source calls the speculative public incorrigible.
And you see why with eToys.com, boom again. Here's a company literally spending $2 for every $1 toys it sold. Losing money hand over fist.
It did IPO.
Soared. Up 282% on day one. Its market value ended up almost $2 billion higher than Toys R Us, which was huge and profitable.
That's just madness.
Total madness. And of course, eToys went bankrupt too after burning through nearly $400 million. Investors were completely blinded.
So wrapping this all up, what's the big takeaway from looking at these patterns across decades?
Well, the sources seem to suggest it's not necessarily that the rules are broken or the warnings aren't there. It's often the public's own. Maybe heedlessness is the word.
Yeah.
And greed.
People overlook the obvious flaws when they think there's a quick buck to be made.
Exactly.
Yeah.
Which leads to this really interesting, kind of provocative final thought from the sources.
Yeah.
Given how predictable these collapse patterns are, these four extremes we've talked about, shouldn't responsible investment banks, the ones sponsoring these IPOs, feel some kind of ethical duty?
A duty to do what?
To maybe not bring offerings to market that look, well, almost foredoomed to ultimate failure, even if the public is clamoring for them?
That's a tough question. Refraining even when there's demand.
It's a tough one. And like the patterns themselves, that ethical question just seems to keep coming back around.
Welcome back to the Deep Dive. Today we're digging into something pretty unique from our source material, a really interesting way of looking at things. It's about comparing companies, pairs of them actually, some that seem kind of similar, but, well, financially are worlds apart.
Right. It's a novel technique. The sources call it a novel form of exposition, basically using these contrasts to show investment attitudes, and corporate realities.
Exactly. So our mission here is to pull out what this tells us about market behavior, specifically how investors react to, let's say, glamorous growth and speculation versus maybe boring underlying value.
Yeah, the glitter versus the grind.
Good way to put it. Let's jump right in with maybe the peak of that kind of thinking, the dot-com bubble. We've got this great comparison, Cisco versus Cisco.
Ah, yes, the classic pair. So think March 2000, Cisco systems, everyone knew them, internet equipment, the glamour stock.
Easily the future, right? That's what everyone thought.
That was the story. Its market value hit $548 billion. And get this, it was trading at 219 times its net income. Just astronomical.
219 times earnings. Wow. Okay, so who's Cisco in this picture?
Cisco Corp, food supply, think distribution, logistics. Not exactly thrilling tech. Very mundane business.
Okay, so different vibes. How did the numbers stack up?
Well, here's the kicker. Cisco actually had more revenue at the time, about $17.7 billion compared to Cisco's $14.9 billion.
Oh, revenue, but I bet the valuation wasn't anywhere near Cisco's.
Not even close. Cisco's price-to-earnings ratio, its PE, was only 26. I mean, perfectly respectable, but compared to 219, it's miles apart.
So what explains that massive gap? It's purely sentiment.
Pretty much. It's fascinatingly emotional, really. The sources talk about how Cisco felt like the industry of the future, while Cisco just made people think of, delivery trucks. And I think one source literally said shepherd's pie.
Shepherd's pie versus the internet backbone, okay. And how did that play out? The sequel, as the source calls it.
Well, reality bit, as it tends to do. Between 2000 and 2002, Cisco. Ouch. It lost 3/4 of its value.
75% gone.
Yep. Meanwhile, Cisco, boring old Cisco, it gained 56%.
Wow. So earnings eventually mattered more than the excitement?
Fundamentally, yes. It shows how the market might, scoff at sound principles for a bit in the short run, but it almost always comes back to them eventually. That long-term weighing mechanism kicks in.
Okay, so that Cisco example is pretty stark, but you mentioned things got even more extreme.
Oh, yeah. Let's talk Yahoo versus Yum Brands. This is late 1999, maybe peak speculative fever.
Yahoo, another .com darling. And Yum Brands is KFC, Pizza Hut.
That's the one. Fast food, pretty straightforward business model.
Yeah.
So Yahoo's valuation, $114 billion market value.
Big number. What was the PE on that if Cisco was 219?
Hold on to your hat.
Yeah.
Yahoo was priced at 3,264 times its earnings.
Wait, say that again. 3,000?
3,264. It's almost meaningless, right? Part of that, interestingly, was driven by its inclusion in the S&P 500 index. Funds had to buy it, pushing the price up regardless of fundamentals.
Forced buying. Okay, and Yum Brands, the KFC folks.
Their market value was about $5.9 billion, trading at just 9 times earnings. And here's the crazy part. Yum was actually making 17 times more net income than than Yahoo was.
So making way more actual profit, but valued at a tiny fraction. It's the same pattern, just dialed way up.
Exactly. The market's voting machine was just completely off the rails.
And the outcome, predictable by now, I guess.
Pretty much Yahoo, that stock. It lost 92.4% cumulatively from 2000 through 2002, just wiped out.
Yeah.
Yum. Brands gained 25.4% over the same period.
Incredible. But wait, there was one more example you mentioned, something about math literally breaking, the 3Com thing?
Ah, yes. The Palm spinoff from 3Com.
Yeah.
This one is legendary for showing just how, well, stupid the market can get sometimes.
Okay, lay it on me.
So 3Com spun off its Palm PDA unit via an IPO. The hype around Palm was immense.
I remember Palm Pilots, yeah. Hot stuff for a minute there.
Exactly. The newly public Palm shares were priced so ridiculously high, I mean, completely irrationally, that the market value of the Palm stake, owned by 3Com, became worth more than 3Com's entire market capitalization.
Hang on. So the part was worth more than the whole?
Yes. Which meant, if you did the math, the market was assigning a negative value to all of 3Com's other established profitable businesses. Everything except Palm was apparently worth negative $22 billion.
Negative $22 billion. That doesn't even make sense.
Yeah, it makes no sense. It's like saying, I'll sell you this profitable company and I'll pay you $22 billion to take it. It was just a moment of pure market disconnect from reality.
Wow. That's something else.
It really is, and it connects to this bigger idea. Ambrose Bierce called it incompossible.
Incompossible. Like impossible.
Sort of. It means two things that logically cannot exist together at the same time. Like a company could be a huge entity, or it could deserve a giant PE ratio, a huge multiple, but being both, a giant company and having a giant PE, that's fundamentally incompossible. It can't last.
Because huge companies just can't sustain the kind of hyper-growth that justifies those massive multiples.
Exactly. So the big question this all raises is, why do investors, time and again, seem to ignore basic things like profitability, like assets, and just chase momentum, chase the story until it blows up?
Right. So wrapping this up, what's the key takeaway for you, the listener, from all these comparisons?
I think it boils down to understanding those two market modes we talked about. In the short term, yeah, the market acts like a voting machine. It's driven by popularity, by sentiment, by hype.
The Cisco story, the Yahoo story.
Right. But over the long term, it always becomes a weighing machine. It weighs the actual substance, the earnings, the cash flow, the real value.
So the final thought then is this. If you find yourself buying a stock only because the price keeps going up without really asking if the company's value is actually increasing alongside it,
then regret isn't just likely, it's pretty much a certainty down the line.
the real challenge for you isn't spotting these bubbles years later. It's asking, what's the equivalent pairing today? Which company is selling, the modern version of $17 billion worth of shepherd's pie, steady and maybe unexciting? And which one is selling pure glitter? And more importantly, how are you valuing them? Okay, let's unpack this. This deep dive is really for you, the listener. If you're interested in quickly getting a handle on, the relationship between shareholders and the companies they own, we're focusing right in on corporate governance, dividend policy, some maybe uncomfortable truths there.
Right, and we're blending that classic investment wisdom, think Benjamin Graham, with a look at, modern corporate efficiency and those tricky conflicts of interest.
And the central conflict, it seems, goes way back. Graham pointed this out. You buy a stock, you're an owner, right?
Theoretically, yes.
Yeah.
Managers work for you.
But Graham said, in practice, shareholders were often, and this is his phrase, a complete washout.
Yeah, just voting in sheep-like fashion for whatever management wanted, even if things were going badly.
It sounds like total apathy. So Graham, back in, 1934, he starts this crusade.
He did, trying to get shareholders to actually challenge unproductive management, when results were poor or the stock price just stayed stubbornly low for ages.
So did it work? Did shareholders rise up?
Well, here's the surprising part. Practically nothing was accomplished by the shareholders themselves.
Really?
Yeah. The whole cause got rescued almost accidentally by something else entirely: takeovers.
Takeovers, how did that help?
Well, those low market prices made companies attractive targets for outsiders. They'd come in, acquire control, and essentially bail out the inert public shareholder.
Huh. So the pressure wasn't internal from the owners, but external from potential buyers.
Exactly. And that threat, the possibility of a takeover, that's what puts boards on notice today.
Ah, okay. It forces them to keep management performing, which is why maybe we see presidents changing more often now.
That's a big part of it, which leads us nicely into dividend policy. because that's about what management does with the cash.
Right. And historically, shareholders wanted that cash, didn't they? Liberal dividends were the norm.
Oh, yeah. Payouts were typically high. Think 60%, maybe even 75% of earnings. Shareholders expected it.
But that's really shifted now, especially with strong, growing companies. They keep dividends low. Deliberately.
They do. It's the daddy knows best idea. Management says, look, we can use this money better than you can.
For profitable expansion, right? That benefits the shareholder eventually.
That's the argument. And it worked. I mean, the average payout ratio plummeted, down to maybe 35%, 40% by the late 90s.
But here's the paradox, isn't it? Does the research actually back that up? That keeping the cash always leads to better results?
Often it doesn't. It's fascinating, really. Studies found that when current dividends are high, future corporate earnings also tend to be higher.
Wait, higher dividends leading to higher future earnings? How?
It seems to impose discipline. Paying out dividends yanks cash out of managers' hands.
Before they can squander it?
Pretty much. Before they spend it on, say, questionable acquisitions or maybe inefficient pet projects. It forces them to focus only on the best uses of capital because there's less of it lying around.
Okay, so for you, the listener, the intelligent owner, you need ways to monitor this.
Absolutely. And a critical tool still is the proxy statement. That document asking for your vote. Think of it like a canary in a coal mine.
A warning signal. Like with Enron, right? That wasn't even complicated financial analysis.
Not at all. Just reading the certain transactions section, seeing the CFO was managing partnerships, buying assets from Enron.
Yeah, that screams conflict of interest. Simple common sense.
Profoundly disturbing conflicts, as the commentary put it. And if conflicts are one issue, another is just, well, waste, often hidden.
Like stock buybacks. They sound good. Boost earnings per share.
They sound good, but often there's a more, let's call it sinister purpose, counteracting dilution.
Dilution from all the stock options handed out to executives.
Exactly. Your ownership slice gets smaller when they issue shares, often cheaply to insiders. Then the company uses your money, the corporate cash, to buy back shares on the open market, often at much higher prices.
Like Oracle did, issuing stock low, buying it back high.
A classic example. Issued shares to insiders at an average of about $3.53, then repurchased shares in the market at an average of $18.26, just to keep the share count from splitting.
Wow. So using shareholder money to basically cover the cost of executive pay.
That's one way to look at it.
Yeah.
So the key takeaway for you, the owner, really boils down to this. Demand clarity.
Meaning?
You should expect either a normal payout, say 2/3 of earnings, like the old days, or
what?
Or clear, undeniable proof that the money they kept, the reinvested profits, actually produced a satisfactory increase in per-share earnings over time. Show me the results.
Right. Don't just tell me daddy knows best. Show the proof. Okay, so final thought here. Imagine if every investor did become that vigilant, intelligent owner. And what if independent directors had to report directly to shareholders? A public report confirming executive pay was justified, confirming dividend and buyback policies made sense.
That would be something.
How much would corporate governance change? And maybe more importantly for you listening, what would that report reveal about the companies you own right now?
Welcome to the deep dive. Today we're tackling something absolutely fundamental, maybe the secret of sound investing, distilled into 3 words. Margin of safety. You know, there's that old legend about boiling down all of human history to just, this too will pass. Well, margin of safety or morass is kind of the investment version of that, wouldn't you say?
I think that's a great way to put it. It's the ultimate defense against not knowing the future.
Exactly. So our mission today is to really unpack this concept. Why is it the bedrock, the sort of common thread in successful long-term financial thinking?
Well, the beauty of it, the core function, really, is that it makes having an accurate crystal ball unnecessary.
Okay.
Yeah, you don't need to perfectly predict next year's market if you've already built in this huge cushion.
Right. So let's start where it's maybe easiest to see, easiest to measure. Fixed claims, like bonds. How does morass work there? What's the actual math?
Okay, so with bonds, it's all about coverage. Historically, for a bond to be seen as really safe, investment grade, the company issuing it needed to show earned its fixed charges, interest payments.
Yeah.
Better than 5 times over, say, a decent period of years, before taxes.
5 times?
Yeah.
So for every $1 they owe in interest,
Yeah.
they're actually making $5 in operating profit.
Exactly. That's the earnings cushion. That's your margin right there.
Okay, that's the earnings side. What about the assets? Is there another way to look at the cushion?
Oh, absolutely. That's the asset cushion view. You basically look at the total value of the business versus how much debt it has.
So like,
So if the whole company is worth, say, $30 million, but it only has $10 million in debt,
right.
then you've got a $20 million cushion. The value could drop by 2/3. And the bondholders, well, they're still whole.
That's a significant margin.
Okay.
So that makes sense for bonds. Pretty clear arithmetic. But how does this translate to common stocks? Because valuing stocks is much fuzzier, isn't it?
It is fuzzier, but the principle is the same. You just have to adapt the calculation. Instead of fixed interest charges, you look at the company's earning power relative to the price you paid for the stock.
Earning power. So like the earnings yield.
Precisely. You need a good spread, a favorable difference between that stock's earnings yield and what you could get pretty much risk-free, like on a government bond.
Okay.
Let's say the stock yields 9% based on its earnings and the price you paid, and bonds are yielding 4%. That 5% difference, that's your annual margin accruing in your favor.
And over time.
Over, say, 10 years, that 5% a year adds up. It builds a buffer, maybe 50% of your initial cost, against things going wrong or you just being plain wrong about the initial value.
Okay, but here's where it gets, well, tricky, right? Because sometimes that margin just evaporates. We've seen times when stock earnings yields aren't much higher than bond yields at all.
And that was Benjamin Graham's big warning, especially around 1972. He pointed out that when the earnings yield on stocks basically equals the interest rate on bonds, your margin of safety is gone.
So no cushion left.
Pretty much. He talked about a negative margin of safety then. If you bought a typical stock at, say, 12 times earnings, its earnings yield is about 8.3%. If bonds were yielding close to that, well, you had almost no room for error.
Wow. Which means even a diversified basket of stocks could be really risky if you bought it at too high a price level overall.
Exactly. But Graham also warned about something else. The danger isn't just paying too much for good companies, it's also buying lower quality stuff during a boom.
Ah, yeah.
And mistaking those temporary high earnings for sustainable earning power. That's investing with basically zero margin of safety. Very dangerous.
So this MOS concept really draws a line in the sand, doesn't it? Between investing and, well, speculating.
It absolutely does. Investment, true investment, relies on, quantifiable analysis, arithmetic, data, that cushion we talked about. Speculation, that's more about gut feelings, market timing, thinking you're smarter than everyone else.
Is the difference between calculation and hope, maybe?
Something like that. And MOS is clearest when you find those bargain issues, where there's a really obvious favorable gap between the price you pay and a conservative estimate of the underlying value.
Right. And how does diversification fit into this picture?
They go hand in hand. MOS on an individual stock gives you a better than even chance of profit over loss on that specific bet. But diversification is what ensures that across your whole portfolio, the total profits from your winners are overwhelmingly likely to outweigh the losses from your losers.
Like the casino versus the player.
Exactly. The house relies on probabilities across many bets, not just one spin. MOS gives you the edge on each bet. Diversification makes sure the overall odds work in your favor.
Okay, so pulling this all together, what does this mean for you, the listener, today? The source material suggests the biggest risk isn't really in the market, it's in us.
That's right. If the math gives you the financial MOS, you still need a behavioral MOS. And that's where thinkers like Daniel Kahneman come in.
How so?
You need to honestly assess yourself. Kahneman talks about well-calibrated confidence. Ask yourself, what's my actual track record? Am I as good at predicting things as I think I am? Be brutally honest.
Okay, confidence calibration.
Yeah.
What else?
And critically, correctly anticipated regret. How will you really feel and react if you're wrong, if the investment goes south? If you haven't thought about that potential pain and your reaction to it beforehand, you might panic at the worst time.
So it's almost like a pre-mortem for your own emotions.
In a way, yes. It connects to that older idea, like Pascal's wager.
Yeah.
Focus less on just the probability of being right and more on the consequences of being wrong.
Manage the downside.
Manage the downside relentlessly.
Yeah.
Keep diversified. Don't chase fads. Control what you can control, which is the potential for catastrophic error. Do that. Build in that margin of safety financially and behaviorally.
And then whatever happens.
You can weather the storm. You can genuinely say, this too shall pass away.